volatility. So we're using options on the Australian dollar that expire in 1 week. This is at the money. So the strikes on this are at where the current market price is. Now, remember, this number here, 5.6725%, is an annualized number. It's an annualized number, but it represents the options that are taking place that expire within that 1 week period. And what we're trying to do is we're trying to get context on that implied volatility. The market has looked ahead at the week that will be starting on Monday and said, you know, we've got this data point in Australia, we've got this in the US, we've seen, you know, the journey that we've been on, and we'll take that on board as well with realized volatility. But we're looking ahead, and we're going to give this a 5.67525 implied volatility. Now, what we do is we try and get context on that. What's that actually mean? Well, the market's saying here that that we could see over the course of the year, if this was to be held for, if it was a yearly option, this would move 5.6725%, which doesn't sound like a lot. But we now need to put on context, and this is what IV rank, implied volatility rank, does. It puts it into the range of the high to the low. So the calculation we're using to get implied volatility rank is the current implied volatility, which you can see there, 5.675%, take away the absolute low and divide that by the difference of the high to low range. And that gives us the second percentile. So what we're trying to understand is the market's looked ahead at the coming week and said, well, at 5.67525%, that's the second percentile. We don't expect much of a move. We don't expect fireworks to come through. In fact, if I go to my spreadsheet, we can see there that annualized move. If we want to try and actually, we actually want to take this down to a weekly one. So we know that that's a weekly option, but it's an annualized figure. If we actually want to take that annualized move down to a weekly move, we can just do it with a trickery, and we just need to do it as square root there. So it's a little bit of maths involved, but we know that volatility is the square root of time. Now we know there's 50 weeks in a year, 50 trading weeks in a year. So we're just taking that number there, that 5.675%, and we're going to square root that by 50. And what we find then is that the implied volatility on a weekly basis, the expected move on a weekly basis, is 0.8. So the expected move on an annualized basis is 5.675%. Now what we can actually do is we can work out the expected move from this by simply going here and getting the market price, which we see at the current market price now, which is 67.86, timesing that by 10,000, and then timesing that by the weekly move, and that will give us the implied move of 54 points on the week. So it sounds quite complicated, but all we know is that that's an annualized move expressed. So we can take that down to a weekly move, and then we can actually say, well, what is the expected move up or down? And implied volatility is agnostic in terms of direction. It can be up and it can be down. It doesn't have to, volatility doesn't tell you where the market's going. It just tells you the extent of a potential move over that period. So that's what this does with an annualized move, which we can take down to weekly moves just by square rooting it, but it gives you a context of where the implied volatility. We can get implied volatility for overnight options. So this is really good if you're trying to assess an event risk the night before. If I come in and have a look at the RBA announcement, and it's in the morning, for example, 2:30 is the announcement, we could come in at 10 o'clock and say, well, what's the implied volatility on the day, and get a sense of whether the market thinks there's going to be a big move on the day by having a look at the implied volatility. Traders are betting or speculating on those daily options and actually saying, well, you know, if we think there's going to be a big move, then of course you're going to go and buy those options. And that's where this implied volatility rank really comes in. It gives you that context you're looking for. Everyone looks at the commitment of traders report, but I want to have a look at this thing called the volatility smile. It's called risk reversals. And again, you come to my spreadsheet and you can see, let me just bring up the spreadsheet. You can see in that bottom left corner the risk reversals. So what are risk reversals? What does that actually mean? Because to me, they are one of the best guides for sentiment that you can possibly get out there. Getting that information is very difficult unless you're actually trading with an options broker, but we can apply this to our just generic FX trading and our normal commodities trading, just by getting a sense of how the market is structured and where they see the potential moves going. We can see here that at the money implied option for the week, 5.675%. There it is there. You can see it at the money. Now what we've got here is a structure of the market in terms of the deltas. The delta in an option is simply the rate of change that we see relative in the options price relative to the underlying. So if the Aussie dollar is going up by 1%, and we've got a 25 delta call here, the option is going up by 0.25 of 1%. And very simply, we're not really too concerned about that. What we are concerned about is the fact that deltas give us an implied probability of the move actually taking place. For example, a 25 delta put, whatever that expiry is or whatever that strike price is, we don't know what that is at the moment, but the 25 delta put is basically saying, the market is saying whatever that strike is, there is a 25% chance of that strike being in the money. The market is giving you categoric levels by which you can define this by. You know, we look at our spot FX trading, our commodities trading, and you know, it's really difficult to put statistical numbers on things. That's where the options market comes in really well. You know, it is based on maths, it's based on statistics. So we can actually come out with statistical numbers that people, you know, market makers and the market through supply and demand give us, and we can actually quantify various levels in the market. And what we can see here is if we go out to the various deltas of 10p means whatever the strike is at that time, there is a 10% chance of that being in the money. That's obviously very low. We don't know what that strike is, and frankly, we don't really care. What we're saying is to go out and find us a strike that has a 10% chance of being in the money. You can see the other side of that on this side here, 10 delta call. So puts give you the right to sell, they're bearish. 10 delta calls give you the right to buy. And what we're trying to do is trying to understand how the market's structured. It's called the skew. These are risk reversals. And you can see here at the moment in the Aussie dollar, if we go out to a 25 delta, so slightly out the money, the market's giving us a 25% chance of actually getting in the money. You can see that the implied volatility, the annualized number for that week, is 5.89%. You can go here and look at the call, which is the mirror opposite of a bullish structure here for the Aussie dollar over 1 week, and you can see that 5.71%. So people are paying a higher level for options in this 25 delta put relative to calls. So how am I looking at this at the beginning of the week? Well, the market's saying to me that there's more downside risk, and they're prepared to pay higher volatility for downside protection. You go out to the 10 deltas, which is a really strong outlier move, and you can see here that the market is saying that there's they're putting us an annualized volatility at 6.2% relative to 5.89%. So if you take away that via that, you can see that the skew is negative. And that's why these risk reversals are really great tools, because they give you a sense of what the market is expecting. Where is the risk lying in terms of the direction going forward? So what we can do now is we can use those concepts to give us an implied move over a period. And what we do there is using that implied volatility. That implied volatility, as I showed you with the spreadsheet, gives you an expected move up or down. But what that implied volatility doesn't take into consideration is things like the risk-free rate. It kind of over-exaggerates things a little bit. And we wanted to know what the market's prepared to pay to buy volatility, and we can use that in our risk management. So what we do is I'm going to ask the system, and in this case it's Bloomberg, just to tell us what the market's expecting for an exact move over the week. There's our implied volatility. The midpoint of that is the number that we've used, 5.625%. We can see here, this is the strike of the option, which is pretty much there. It's at the money. The strike is at the money there. We can see this expiring in 1 week. This was when I did the situation there. And then we've used the risk-free rate, which I'm not sure what Bloomberg used, but they've probably, it's very low. And then they've added this all together and they've come up with this number here, 47 points. The market's saying we are prepared. We think that the Aussie dollar, based on all this information that we know going forward in this week, all the data, all the event risk is going to trade 47 points from spot, up or down. So that's with a 68.2% level of confidence. Because we're using implied volatility that's at the money, this is giving us a 1 standard deviation move. So remember that 68.2% chance of being in the money. The market is giving us 47 points. If we go to the payoff diagram, just to show you how this works in principle, you can see here that the current price at the time was 70.31. The market was prepared to pay 47 points. So you can see it goes down to 69.84, but they think, volatility is agnostic. It can be either direction. And you can see here that the market thinks on that side that it could be as high as 47 points that way. So when you're buying volatility, you don't care which way it goes. You just want a big move, and you make money if your position or the market trades a lot higher than this. But the market has said everything that we know with that implied level of volatility that we're going to trade in this range here. That the vol sellers are going to expect to see it trade below this level here. The vol buyers, the volatility buyers, would expect a bigger move here. But the market is telling me I'm not trading volatility. I just want to know for my own risk benefit the expected move, and we can see a 47-point move here. What we can also do then is actually use this other strategy called a strangle. And what a strangle does is, rather than use an at the money implied volatility, we can take our level of confidence out. We can say, give us an extreme move. That one there was using a 50 delta effectively. But I'm saying to the system, go out and find something that potentially is an extreme move. And what we've got here is a different method called a strangle price. And what it does is we've asked the system to go out and find us a strike with a 10 delta, a strike which the market gives a statistical level of 10% of being in the money. And what the system has shown us there is that option, the call, is 71.11. So it needs to trade up to 71.11, or on the put side, 69.60. And you add the premium. The premium there you can see is very low compared to 47 points on the last one, which was a 50-50 bet effectively. But what you've got there is, because there's only a 10% chance of actually this being in the money, the market's very low premium. So to make money on this trade, you have to add the premium with the potential move to those different strikes. So what we got is a situation here on the payoff diagram where I know, based on what we're seeing there, that the market is expecting the price to trade to 69.54 or up to 71.16. And that's with a 90% level of confidence, because there's only a 10% chance of that being in the money because it's 10 delta. And therefore, there's an 80% chance of it staying within this range. Now, how does that look like that to me? And I'm sort of rushing through this because this sort of presentation does take a lot longer. But when I look at this at the beginning of the week, this is what I look at. So the market has told me that they see with a 69.8% level of 68.2% level of statistical confidence. Remember, that's a one standard deviation move, and at the money is one standard deviation, that it's going to trade 69.84 to 70.78. Or if I take that strangle pricing out to a 10 delta, which gives me a 90% level of confidence up to this level, and a 90% level of confidence down to this level that it's not going to move any further, well, then you've got the price trading 69.54 to 70.11. So that's what it feels like to me. If I was running an expert advisor, I would say to myself, well, actually, I'm quite happy with the market trading in these levels. I can put a statistical level of confidence around that. And then, I'll be happy to run my EA. Remember, the implied volatility was at the second percentile. The market's not expecting big moves there. So we've got this statistical level which is in the market. We're looking forward, and the market's telling us what they think. Rather than use your own initiative, let the market tell you what they think around all the event risk. And you can actually put this playbook into practice using statistical probability of what the market would pay. I'm not going to go into there. Okay, I'm going to give you an example about how I saw the Fed meeting. I'm going to put this into practice. Okay, so the first thing I did is I came in on the Monday morning and I said to myself, well, we've got a Fed meeting on Friday. What is the first thing I asked is what is the number of basis points being priced into the Fed funds market? Now, I want to understand what's being priced in here, and you can see here that the Fed funds market is pricing in 118 one full rate cut and 18 basis points, 18% chance more. So I knew that there was a pretty good chance that the Fed were going to cut rates, but also there was a bit more being priced in. I looked at what the economists were calling, and I could see there that most economists were calling for 25 basis points. There was a number of 10 or so who were calling for rates to be kept on hold. those people clearly didn't listen to a single thing the Fed was saying, and there was a couple who were calling for 50 basis points. But I'm trying to understand my probability setting for the beginning of the week and how markets may act based on what's being priced in. So there was a full rate cut was being priced in. There was an 18% chance of a 50 basis point cut. How's the dollar? How are the markets going to react on the back of that? I've chosen dollar yen here to look at because I think it's the most clean version of how the markets would trade. It's probably the closest line to US Treasury yields. And what we looked at on the Monday was was dollar yen weekly volatility annualized at 6.3150. Now, considering we've got the most anticipated Fed meeting, of all, well, for many years, they're going to cut rates first time in a decade. The implied volatility was at 32 percentile. So I was telling clients, look, we've got this massive event, but the market's not expecting fireworks. You can see here the average line, this blue lotted line, they've got one standard deviation here. So it's really around average of where we've been over the last 12 months. I mean, I can take the context lower and I can look at how things have been going in the last couple of months or so. But over the last 12 months, which is really where you look at the implied vol rank, you can see that it's actually not high. So immediately I thought, well, lots being priced in. The market's not implying a big move. We had a lot of clients who were saying, we're going to see fireworks this week. We're going to get a rate cut. And I'm like, well, actually, the market's not telling me that. I can look at my system. I can look at the at the money straddle price, and I can see that the strike there, 108.55. It's at the money. It's the closest one they could find. I can see my expiry there. I can see that level of implied volatility, which we had, 6.315. We've applied that to the system. And the market said over the course of the week, we expect a 75-point move up or down. So the market's told me, well, we're going to get a 75-point move. Now, you can go and buy and sell volatility based on that in the options market, but we're not trying to do that. We're just trying to anticipate the expected move over the Fed meeting and all the other data points that come through. You can see there from the current at the money spot level that's the kind of moves we're expecting, 150-point range effectively in that situation. But then I say to myself, well, actually, that's a 68.1% or 68.2% level of confidence. Go out to the system and give me a really big move. Tell me what an outlier move would look like in that situation. And you've got the market trading at 108.67. We've taken our deltas out to 10. So we've found strikes, which you can see here, which have a 10% chance of being in the money, or the market's applying a 10% chance of being in the money. And you said there 109.80 to 107.19. If you add the premium to both legs, you've got a situation where the market's saying that we probably go down to 107.05 and 109.93. So what does that look like? This is what this looks like. At the beginning of the week here, this is what I was looking at. So we saw with what the market was telling me with a 68.2% level of confidence that we would trade up to 109.30 and down to 107.80 with an 80% level or 90% level of confidence getting up to the top, or a 90% level of confidence getting down to the bottom, that it wouldn't trade any further than these points. If you did, you go and buy volatility, that it would stay on an 80% level of being in this range here. This is just Bollinger Band. So again, this is realized volatility. But you can see here that the market is saying that we expect to stay within this range. So, I was looking at my risk and I was saying, well, actually, if I was going to be in a position, if I held a position, this is kind of the level that I'd be looking at having a stop. Now, you'd obviously look for a natural point below a specific market pivot or a retracement level. But I could say here with a statistical level, the market has told me that they see this as being an extreme move on the week. And therefore, I could have some pretty good confidence that I could have my stop loss below this level if I'm long. And, you've got obviously got this nice resist support levels that are kicked in. But the market has given me a statistical degree of confidence of how far I can have my stop loss. And of course, in that situation, when you're taking more or less risk on, then you can adjust your position size accordingly, and you can see the levels there. So what I'm trying to understand is what the market's telling me. I can put that through the system and it will give me an expected move. The next thing I look at is non-commercial, so looking at where the market's positioned. At the time, the market was a little bit on the short side. You can see 9,000 short, so it's not really giving me much. We're going into the beginning of the week on dollar yen, but again, you could have applied this to gold, you could have applied this to treasury markets, you could apply this to the S&P. This whole holistic stance on how you're reviewing the market at the beginning of the week, you can do with all these different assets. And you can see here, the market was pretty neutral, so it really wasn't giving me too much, but it was part of my holistic assessment of dollar yen. I can have a look at risk reversals, and you can see here that's where are at the money, so a 50-50 bet effectively. Market can only go down or up, and that's why the market puts a 50% level on confidence on that. But if we go out to the 25 delta puts on dollar yen, you can see that the implied volatility annualized within that week was at 6.8425%. Compare that to the calls, which are bullish, obviously, and give you the right to buy dollar yen over the course of that week on the expiry. And you could see that the market was prepared to pay less, or expecting a less relatively large move on dollar yen at 6.14%. So if you take this number away from this, you can see that the market is skewed on the bearish side. If you take that level of statistical probability out, to a really big move, the 10 deltas, a 10% chance of being out the money, which we used on that strangle, you can see here that the implied volatility is significantly higher than what we see on the put. So people have been saying, we think that there's going to be a much bigger move to the downside than to the upside as we go in through the week. So again, we're looking at that situation. And gold's a really interesting one now, because if you were to look at the risk reversals in gold, you can see here on my spreadsheet, they're at 3.7%. So call volatility is significantly more expensive than put volatility. In fact, if we skew rank that from the implied volatility rank, that's at the 91 percentile. So the market has been paying for call volatility. And actually, this is, I think, one of the best ways of looking at sentiment in the market. What is the skew of call volatility relative to put volatility? And you can see in gold right now, we're pretty much near, well, not a million miles away from record highs, which tells you that there's a lot of love for gold. And that's where this spreadsheet comes in. It tells me, what the market is positioned and where they expect to see the direction coming through. So this does give you a sort of a directional bias where the market sees the potential going. But we came into the beginning of the week and we looked at dollar yen. Where's the options market seeing the risk for this week? And that's why this risk reversal or the skew is really important for me. We can I can see we're getting on for a bit of time, but if we look at that skew there, the difference between the 25 delta calls and the 25 delta puts, and the differential between the two, we can actually look at that as a number in itself. That number works out to be negative 0.6975, and actually, that chart looked quite interesting. It looks like it's really steep. Like people are paying a lot more to that, but we can put context on this by putting a chart out here. And from time to time, I'll put charts out around this, giving context to people who are on the distribution that I send out every day. And you can see here, while it looked quite dramatic when we actually chart this, the skew wasn't actually that much extremes. We tend to see the market paying up for put volatility because people have been expecting downside for some time in dollar yen. You can actually see these getting below -2, that's where the extremities lie. So at 0.6975%, yeah, fine. People were skewed for a downside move in dollar yen throughout the week, and that sort of played into my view. But it wasn't particularly any kind of extremes. And then what we saw is on the Fed meeting itself, you can actually see we saw a little bit of a pop. I guess that's probably because they said that we're in a mid-cycle adjustment. The market didn't like that situation. But then what we actually saw was a big move down in dollar yen. Why? Because the market saw something that they hadn't actually already anticipated on the Monday. And that's where it's really interesting with implied volatility, because while it looks ahead at everything they know, it is everything that they know and expect. And what we hadn't been expecting was for trade tensions to start ramping up, and then the market therefore has to reprice itself. And we saw this big move down. So when we get new information into the market has to react, it has to adjust, it has to try and understand what that actually means. In the beginning of the week, we hadn't been anticipating trade tensions to be coming back in. In fact, the trade truce was at the back of people's mind. People were seeing some signs of better data in the US, and that's why they obviously only cut by 25 basis points as opposed to 50 that a lot of people were hoping for. But actually on the day when we saw this as part of our risk assessment using this process, we actually only saw a little bit of a pop, and that sort of played into the idea of what we saw with those potential moves. Remember I said that the market saw with a 68.2% level of confidence only about a 70-point move on the week, and that was playing out quite nicely. And then of course we got the Trump tweet, which startled the market, and that wasn't in the price. So when we're looking at this process and what the market's expecting up or down, it's only taking into consideration what you know, what you actually understand. As new news comes in, it has to be repriced and readjusts, just as we'll do with our spot FX trading and trading on indices. So let's have a look at what this all means now in terms of the spreadsheet. So we get a better understanding about how this goes. We've got our realized volatility. This has happened, and we can still use this to great effect. If you've got a strategy that involves this, I think this just gives you that color. We've got Aussie. I can add or take away different crosses, whatever. I mean, it's very easy to get this information. You can see here that the average true range on the Aussie dollar over the last 5 days is 57 points. Compared that to the implied move over the coming 5 days, and you can see that the market is saying that's around 70 points. The applied move, and I took this on Friday, 8.71%. So what does that actually mean? Well, we know that number there is the annualized at the money implied volatility with a 68.2% level of confidence. We can actually then put context around where that's been over the last 12 months and see that's 51 percentile. Okay, so the previous example I showed you on the Aussie dollar was from 2 weeks ago. This is from Friday. So we're trying to understand what this means. So again, when I look at the implied rank, we can see that's sitting mid-range. So it's, going ahead for the next sort of 5 trading days, the market's not expecting big moves, 51 percentile. But then we can put that into our straddle price, where we're looking at an at-the-money option strategy, the market neutral strategy, and the market is saying that they expect to see a 70-point move. Now we can put that into the system from current spot prices, and therefore we can see that over the next 5 days, the market is seeing with a 68.2% level of confidence, statistically, that the Aussie dollar is not going to trade any higher than 68.66 and 67.26. Then we can ask the system using that strangle price for the options traders, go out and find me a strike which has a 90% chance of staying in the money. Market, the 90% chance that the price should not move or settle above that level. And you can see that at 69.07 and down to 66.72. So when I'm looking at the beginning of the week, I can say, well, actually, do you know what? This is probably the number I'll be using. But the market is telling me this is an extreme move. They see this as an extreme move over the week. So again, if you're just trying to understand how your algo is working or your EO is working or your discretionary position and how much risk to take on, most people would probably use an at the money strike, maybe use a 25 delta. But I would actually say to me, what's my worst case scenario? And my 90% is usually your worst case scenario. That would be an extreme move being priced by the market. So I know that beginning of the week that I might take on 118 points, and I probably wouldn't need to do 1.5 times that. I'd probably leave them, and I'd look then forward to find out where the next, the natural point is to leave a stop. Where's a low? Where's a resistance level, or support level, or a resistance level? But the market is telling me there that there is a 90% chance that that the market is not going to trade any higher than that. We can have a look at these same situations for special events. Brexit's an interesting one there. I can ask the system for the implied volatility for the 1st of November, which is 1 day after Brexit. And we can see that 11.86%. So what does that actually mean? I can put that into the system for that date and see that the market's expecting a move in cable of 575 points up or down. So it gives me my expected range. I can say, give me 90%. Now, of course, there's a lot of time going through to that period, which needs to be priced in. But I can see an extreme move being priced by that time of those levels there. We've got our risk reversals, which again looks at the skew. We can see here that Aussie dollar at the moment is skewed on 25 deltas, so a call with a 25% chance of being in the money and a put 25% being in the money. And you can see here that the market is skewed to the downside. They see more downside risks in the short term in Aussie dollar, and you can see that's around the 50 percentile. So it's in the mid-range, so it's not particularly high. What is high at the moment is gold, as I say, 91 percentile. We've got euro dollar getting up to the 81 percentile. A lot of people have been buying euros because we've seen higher volatility in the market, and people therefore have been closing out of those carry trades. And the euro is the ultimate funding currency at the moment. It's not because Europe's looking great. It's not. I mean, we've got political risk rising again. But people have been buying euros because people have been unwinding the carry trade, and you can see that now really quite resonating in the options market, where the call volatility is at the highest against put volatility and in the 81 percentile. You can have a look at futures positions in the commitment of traders report, which is another way of looking at your risk reward assessment. And you can see how the market's positioned in the futures market. And if they're positioned like this in the futures market, you'd probably get to extrapolate that to what it makes it look like in the spot market. Have a look at gold, for example. The level of net long contracts in the market is 226,000. You can see the weekly change here, but you can actually see relative to that skew, the 12-month rank, that gold's 100 percentile. Now, I'm trying to take a view on where gold is at the moment. Obviously, we can see the move that has happened on the daily chart or the weekly chart or any time frame. But you can see here that the gold positioning is at the 100 percentile. The risk reversals are at the 91st. It's telling me right now that there's a lot of love for gold, and if price starts going bearishly, then you might see that being capped. So I'm just trying to understand where the risk rewards lie, and I can see in two of these major factors that gold's got a little bit too much love, and perhaps buying pullbacks might be the way to go. And of course, that's where we start looking at price. We can have a look at what's happened in euros. So it's been a bit of a short covering, but the market's still short. Look at the pound, though. You can see there the 0 percentile. So I've colored conditioned these. Anything above 80 goes green. Anything below 20 goes red. And what you can see here is that on sterling, we've got an extreme positioning. So the market holds an extreme bearish position on sterling, and rightly so. I mean, we're probably going to get a vote of no confidence coming up pretty soon in the UK, probably after the 3rd of September, after summer recess, and the market's very short the pound. But is this move now extreme? Well, of course, we'd have to look at those different charts to see. We can have a look at the start of the week, how the market's positioned in terms of the implied rate path. We can see that as we go into the September meeting, that the market's giving a 46% chance of a rate cut. How does that play into my Aussie dollar trades? How does that play into my high yielding equity positions? We can see over the next 12 months that we're pricing in, nearly or just over 2 rate cuts. They tend to do it in 25 increments. You can see the Fed here, 121%. So the market's now saying for the September meeting that we've got a 50 basis point cut fully priced in. A 25 basis point cut fully priced in, and there's a 21% chance that we're going to get a 50 basis point cut. So again, when I'm looking at this chart at the beginning of the week, it tells me what the market's expecting in terms of those moves, how the market's positioned in terms of the options, what the skew is in terms of the direction, the positioning, and also the implied rate path. And we put this out every Monday to clients and people who are on my daily report. So feel free to sign up. But I think this is what I use myself, just to give me a really clear understanding of what the market's expecting. So we talk about realized volatility. A lot of people use that very nicely and successfully. But for me, it's about what is the market telling me that's going to happen? What are the expected moves, up or down? And what is the extent of those kind of moves? And we can actually put math and statistic to tell us those expected moves. So this is probably a lot of information for a lot of people to take in, and I'll be more than happy to sort of shed a bit more light on where this is all going. And I've got to wrap this up now for time purposes. But what the whole point here is that we can use volatility and what the market's telling us about the outlook for our risk management to understand whether we're going to have potentially bigger moves, what the skew is, what the implied volatility, where the rank is, to give us that confidence about not just what the event risk is going to transcend into prices, but the confidence to trade in and out of those positions during the week. So that for me is more important than what's actually happened. I want to know what's going to happen and what the market's telling me they're going to happen, and we can find that out fairly easily using statistical situations there. So I'll hand it back to Boris. I think I did a job keeping it right into time. But
thank you, Chris. That's very, very interesting. I have one question, and maybe you could just scroll back to the dollar yen trade, because I kind of want to right there. That's fine. I want to just look at this chart from a trading perspective, because obviously what's very, very valuable from your analysis is that we can get exact mathematical levels of where the market thinks the price will go. So the next question after that is, and this is what's interesting to me, is once we break the top or the bottom of that level for the week, that presents, I think, a very interesting trading opportunity, because essentially, if you're a momentum trader, you could say the market price was pricing, 70 points up, 70 points down. We're now 80 points down outside of the bounds of expectation. that means something unique is happening, and maybe there's more continuation. So if you, for example, took a sell stop order at 107.70, which is pretty much, I think, where the level was, you had a really very, very nice trade here on a momentum basis, on a continuation list. You could also obviously trade this conversely and say, once it reaches that level, I'm going to be a buyer with a 30-point stop, because statistically, it's not priced to go much beyond that. But I just thought I think it's an interesting way of applying practical trading techniques using your data onto the charts. That is different from just the mere indicators and everything else that's coming in, because all of these indicators are essentially working off price. Your data is the only one that is expressing trader expectation, which is, both price and sentiment. That's what makes it, I think, so interesting. Would you agree?
Oh yeah, I'm 100%. I mean, but we've got to say that the markets are a living, breathing thing. We take on board everything that's going on, and we adjust and react, and that's why price moves. Of course, if we hear new news, that needs to be discounted straight away. And volatility changes straight away. Options prices change straight away. So we can have the report gives us a snapshot at the beginning of the week. If new major news like we saw from the Trump tweet comes in board, we need to be able to react. And so all this really does is it sets us up for the beginning of the week, and what the market's looking ahead. We do need to react real time to that situation, and we all need to take a discretionary view. Whether that news is sufficient, and if the market changes and we see big moves in price, we react and perhaps we close positions earlier. But yeah, I mean, absolutely. I mean, if there's not a lot of new news, and you see these moves going up into the top bands, then you can take the view that we are due for a breakout in price, or you might say to yourself, well, actually, do you know what? We might see mean reversion coming through here because we've got a lot of options expiries coming through. So yeah, that might be the level where it's, the elastic band's been pulled a little bit too far, and you might see sellers coming in if you've gone long. So yeah, I think there's a lot of ways to skin a cat in this situation, Boris. But I think for me, it's more about looking ahead over a course of a period, and actually being able to assess, put a statistical edge on what the market sees as event risk going forward.
Exactly. Very interesting presentation. Obviously, we'll have all of these slides for you guys. We are certainly running late on time. As I told everybody, this is what being in the market is all about. It's going to be flexible. I just spoke to Linda. We're going to push her back by about 25, 30 minutes. We're going to give Blake Morrow plenty of time to start the show. I want to make sure his mic is not on. I just want to make sure he's logged in. Let me see. I gotta just text him your audio. Blake, are you there?
I'm here.
Oh, good. Okay, I hear your mic. Okay, there we go. You came in. Beautiful.
Hey, good morning, Chris.
Hey, good morning. Good morning, Blake. Blake Morrow, of course, is a man who needs no introduction. He's the head of Forex Analytics, and he'll talk a lot about some of the incredible work they're doing there. But the topic of this conversation today is so interesting, because it is, like, to me, the central paradox in FX. For so many years, we have been conditioned to trade dollar yen as the risk on, risk off pair. And what you're seeing now is this tectonic shift, complete shift away from how stocks trade and how dollar yen trades. And I think that is one of the most important changes going on in FX that could have years on implications for how things are going to be priced and how we should be looking at trades. So I'm going to, without much ado, I'm going to turn over the screen to him. I'm going to make him a presenter. Let me just do this just one second.
Thank you.
Give him the screen.
And I want to thank you for having me, Boris.
My pleasure. I've been looking forward to this presentation all week long, because I find it, the topic really interesting. Now we got the Blake's screen. As always, guys, just relax. I will, ask the questions at the end. Everything is recorded. This presentation is going to be available, so you will, even if you miss a few points during the presentation, you will all be able to watch it again. So without much ado, turning this over to Blake. Is dollar yen still the best FX pair in FX for risk?
Well, thank you very much, Boris. And I want to say, Chris, what a great great presentation that was. And I wish you would have put me behind like an accountant or something that would have put everybody. It would have made my job a lot easier being able to present after somebody like that. But Chris had a wonderful presentation on volatility, and as you probably have witnessed, Boris, volatility has obviously picked up quite a bit over the last 2 weeks, and it's made a hell of a difference in my trading personally, and I think we've all, as traders, really welcomed it.
Hallelujah! I have
yes.
been waiting for this for a long time.
It's been, it's been a tough 2019. I guess I before I even start, I want to say that, I'm the founder of Forex Analytics. We put it together several years back when I left Ally Financial, and when I was the chief currency strategist for the firms previous till we got acquired by Ally Financial, and I also trade for a company called Gellos Capital out of Greenwich, Connecticut, and which is a small boutique firm and I've been trading for them for the last several years. But I'm going to tell you that the last year, I would say last year, volatility has been really low, and it's been difficult. It's been my lowest productivity for the last several years, and it's not because of the way that I trade. It's just because there has not been as many opportunities in the market. But the good news is right now in my opinion, we're at a very pivotal point in the markets where this presentation specifically is going to be very relevant due to the S&P, and also with volatility picking up, and the very timely presentation by Chris. We're all welcoming that, and now we need to see what kind of opportunities are going to present themselves as the market does pick up in volatility. And this is where my presentation about, is the dollar yen still the best FX pair to trade for risk? I feel it's super relevant based on where the S&P is historically. And so, without further ado, let's talk about there are a lot of correlations in the markets that are extremely important, and I really live on correlations, and I always have in the markets. And from a statistical standpoint, you've probably heard the saying, correlation does not imply causation, which means just because something happens, something else is not necessarily going to happen. However, I talk about, in my own daily webinars, which we host free daily webinars every day with Forex Analytics, so we can give you a quick update of what we're seeing in the day ahead. I talk about the domino effect, and the domino effect in the market is real simple. Is if something happens in the market, what else could possibly happen? And I look at it kind of like a puzzle. Every day, it's like I've got this jigsaw puzzle, a bunch of pieces sitting in front of me. Every time I get up and I turn on Bloomberg, and I've got multiple screens of just charts and data, and I'm reading bank research. I look at it like, okay, I've got all these puzzle pieces, and now I have to start putting it all together, or like a domino. And if one domino falls or one domino moves, what's going to be the effect following the market? And that's where correlations really come into play, in my opinion. So, that comes back to the original question: is the dollar yen the best correlated FX pair to trade to the S&P? Because one of the charts that I'm always looking at, and even as an FX trader predominantly, and I'm not saying that I don't trade S&Ps, because I do. I tend to trade the futures contract when I do it. I'm always looking at the S&P, and then I'm trying to figure out, okay, well, what is the best correlation to the S&P if the S&P starts to move? And as you can see, this is a recent chart, and this is from 2014 to present. When I say present, I think I took this picture a few days ago, at least a couple of days ago, and you can see the most recent move down in the equity markets has caused a move down in the S&P. But what you'll notice in this specific correlation, and by the way, what we're looking at here is the dollar yen is the orange line chart. The candlestick chart, well, it's not really candlesticks when you compress them this tight, but that's the S&P. So you can see the S&P has been rallying, and the dollar yen is overlaid over the top of that specific chart. But what do you notice that's happened since 2017? Since the beginning of 2017, we've seen a continued rise in the S&P, but you've seen the dollar yen basically go flat. So when you have this normal correlation of the dollar yen and the S&P moving together, you see that divergence has really taken hold since the beginning of 2017. So I guess the question that I would ask you as a trader is, what changed? And I know Boris, even though he's not gonna say anything right at this moment in time probably, but he knows exactly what changed in 2017. I think most of you know. But Donald Trump was elected as president of the United States. And so what happened at that point in time, at the end of 2016, once the election took place, is you saw the stock market take off. And the stock market has continued to rally since then. Well, minus this decline that we've seen in the S&P last year, but the S&P has been trending higher. A lot of that is due to the market's optimism that President Trump is going to be good for equities. But what we've seen in the dollar yen is less of a response. So the FX market is more, immune to what's happening in American politics versus stocks. And you guys hear it all the time. And, stocks continuously rise based on expectations of what the current administration is going to do on trade and yada yada yada. All right, so there's that, and that factor's really played into the to the market. So if you 16 and you see what stocks going, looking at this a little bit closer up, you see equities are the candlestick charts. The line chart here is the dollar yen. You can see a very strong correlation. As stocks come down, the dollar yen will come down. If the S&P starts trending higher again, the dollar yen will eventually catch up, or vice versa. We'll see one pull down and the other one pull down. Very, very strong correlations. But again, this is the end of 2016. When we had the election, and you can see that the S&P has been on the rise, and the dollar yen has really not responded. Okay, so when I think about those correlations, I have to go, well, how about the dollar yen and the Nikkei? Because when you're taking the dollar yen, you want to pair it up with the Nikkei, as it's strongly correlated to that particular market, and you'll notice that the correlation is much stronger. Okay, and this is a correlation between the dollar yen and the Nikkei currently, and this is from the end of 2009 to present. Now, if you overlay the three of them, okay, what you'll notice here is the S&P, which happens to be in the yellow, okay, and then you have the Nikkei and then the dollar yen all matched up. You still have a very strong correlation between the Nikkei and the dollar yen, but the S&P has kind of pulled higher since then. But what I've noticed most recently is the correlation is still very strong. But what you'll notice in those charts is the downside in the dollar yen and the S&P may be stronger in the months ahead, because what happens is you're seeing the S&P, when it comes down, since the dollar yen hasn't rallied, you'll see the dollar yen pull down as the S&P starts to hiccup a little bit. And we've actually seen it in the last couple of weeks. we've seen the S&P, come off of the all-time highs, and then the dollar yen has been quicker to respond to the downside versus the upside. So when I look at the dollar yen and the S&P, I start thinking, okay, if the S&P goes higher, I'm going to be less apt to trade the dollar yen to the long side, but I might be more apt to trade the dollar yen to the short side if the S&P is coming down. And again, this is so relevant because as you'll see in the charts that we go through, the S&P might be in a topping pattern. So if it is, and we still see that downside in the S&P from here, the dollar yen might be the better trade. And moving forward, the dollar yen, the best correlation would be the dollar yen and the Nikkei. So when you think about the dollar yen and the S&P, if it's still best correlated, I want to take a look at bank rates, because if you think about currencies, the ultimate driver in the currency market is going to be interest rates. As interest rates come up or interest rates grow down over time, that's going to be the predominant driver of the market. But there's more to see than just, are rates going up or going down, or expectations going up or going down, because you have to think about where rates are currently, where they've been, and where they may go. So this is, this is a lot of the central banks from investing.com, and I'm gonna take your focus away from the top three, because when you're talking about the ruble, and Brazil and India's currency, as retail traders, we typically don't trade those. So I'm gonna black those out for a moment. But I want you to see what we have here between the Fed, the Bank of Canada, the RBA, the RBNZ, Bank of England, ECB, BOJ, and Swiss National Bank. All right, which are predominant currency pairs that most of us that trade the FX market are dealing with for the most part. Notice that the Fed rates are at 2.25. Okay, Bank of Canada after that, and then and it escalates down, and then from there we have the ECB, the BOJ, and the Swiss National Bank either at zero or negative interest rates still. Okay, now the reason why this is so important is because what I like to look at as a currency trader is I try to think about what currencies right now are used as funding currencies in the market. Okay, what I mean by that is if a central bank like the ECB offers 0% on reserves, okay, institutions around the globe and banks around the globe are more likely to deploy euros and invest them elsewhere. They're going to put them in, whether it's in equities or they're going to put them in, other central banks. They're just not going to keep their money at zero. So people are going to, not be in euros and deploy them elsewhere. Same with like the Swiss National Bank. I mean, if you hold your money over in Swiss francs, you're actually not getting interest. You're paying interest holding your money there. So no one that's been the Swiss National Bank's tactic over the last so many years is they're just trying to get people not to be buying Swiss francs. So and if as a retail trader, it's hard to buy Swiss francs, because if you buy them, you're going to have to pay a rollover, and you're going to have to pay interest on those Swiss francs on a daily basis. And heck, if you hold it on Wednesday and you get triple rollover for the weekend, it becomes quite expensive. And if you're trading on the size of some of the sizing that I trade on, it becomes really expensive. So I tend not to buy Swiss francs unless I really need to. But on these other currencies, you can hold them. You can hold dollars. You can say, I don't mind being long the dollar. But if institutions need to reverse out of these positions because risk appetite is not so strong, you're going to see some of these trades unwind. And that's why currently I start looking at some of these currencies that have, and some of these central banks that have higher rates, and I try to think about what would happen if risk reverses or the S&P reverses, for example, and traders need to unwind some of these positions. Now, one other central bank that's not on here that I wanted to talk about would be, this is the Mexican currency and the peso. And what you'll see here is rates are still, above 8%. So, and this is one currency I really will focus on as we go into the live charts, because as Mexico has their rates above 8%, that becomes a risk. Should stocks start to unwind, you might see a bigger outsized move in the Mexican peso or some emerging market currencies than you would in some of the G10 type of currencies. All right. So one of the, I want to talk a little bit about the dollar and its safe haven status. All right. A lot of traders come to me, they still remember the financial crisis. They think about 2007, 2008, and they remember the time, and they continue to live in the past and say, oh yeah, I remember when the S&P, you can see, S&P went from 1600, we went down to 666. The dollar ripped. You can see this is the dollar index. It's in the orange. It just ripped. It almost doubled, and there was this massive liquidity issue, and the dollar just rallied. And a lot of people continue to live in that, in the past, and say, the dollar at some point is going to rally. If stocks, come down, the dollar is going to rally. And I tend to agree with that. But what we haven't seen, in years, is we haven't seen the stock market really come down. This is the S&P, and if you look since the financial crisis, since 2000, the bottom we formed here in 2009, the S&P has gone straight up. So we haven't had a real opportunity to see what the dollar would do if stocks come down, because, well, frankly, we just haven't seen the stock market come down. And if you think about, what the dollar has done, this is the dollar matched up to the S&P. You can see the dollar index at the same time, matched up to the S&P. It's been, kind of mixed. We've seen the dollar move up a little bit here in 2014, 2015, and, into 2017. But you have to ask, why did that happen? Well, the reason why that happened is because the Fed really was the only central bank raising rates. Now think about that. Okay, the Fed has been raising rates, and I know a lot of you go, oh yeah, well, Fed raised rates because they wanted to put some bullets back in the chamber, for lack of better terms. They wanted to make sure that they had some ammunition to fight if we start to see a global slowdown. But what has happened is no other central bank has really moved rates, right? Like you look at the ECB, they've been at zero. you look at the the RBA and the RBNZ, they haven't gone anywhere. The Bank of England either. The Fed has been really the central bank that has been raising rates, and the dollar has responded appropriately. But now it's like, okay, well, the S&P is where we're currently at, and the dollar is just kind of stagnating. That's because the Fed really hasn't done anything recently. And now, the Fed is talking about, or is now starting to lower rates again. But the question goes back to, well, what happens, if the stock market sells off? So the most recent period of time you could see here last year at the end of 2018, we had a correction in the S&P, right? We had a 20% correction in the S&P. You can see the S&P is in the candlestick chart. The dollar index, the DXY, is in orange. When the S&P sold off, the dollar index didn't do anything. All right, it didn't. It stayed there. And a lot of people wondered why that is. Well, in my opinion, after this 20% correction, we're not seeing the dollar do anything. In order for the dollar to really respond to any type of weakness that we see in equities, we have to break, technically, that long-term trend line. Or in other words, we're going to have to actually print a lower low in the S&P longer term. And then at that point in time, I will start thinking again that the dollar may come back as a safe haven currency. But until then, I'm less apt to look at the dollar as the stock market's coming down, I need to buy dollars, because that's still a pretty common idea amongst traders, believe it or not. Here we are almost 10 years later. People are like, oh, the stock market's come down, I need to buy dollars. That's not necessarily the case. All right. And I don't believe that to be the case unless the S&P actually starts breaking lower through some of these supports. So if you go back to the question, is the dollar yen the best correlated FX pair trade versus the S&P? What I wanted to do is I wanted to actually go through some charts here and take a look. Okay, so once again, here's the S&P, and this is the chart that we were just looking at. And we were just looking at this, and by the way, all these charts I'm going to be doing a little bit of technical work with you. Okay, so here we have the S&P, that long-term trend line, and you can argue that we may be going higher. We may have peaked. I personally think the risk is starting to build that we may have peaked in the market. And really, technically, let's go over to the weekly chart really fast with the S&P. If you take this move, the financial crisis move, right, from 07 to 09, you'll notice that just above where we're currently at in the S&P is a 261% Fibonacci extension, which for me is a very, very significant extension in the market. So we came within striking distance of that level in the S&P. Then if you look at let me revert these charts. You look at the move in 2018, and you take the high to low. We're near the 127% extension. Whoops. The 127% extension of the move. We came pretty close. We hit new highs, maybe false breakout. Did we create a false breakout, or can we still go higher? That's to be seen. And I think a lot of that comes with whether or not the China and the U.S. are gonna have a trade deal, going into this next year. Everybody's got opinions on that, and my opinion is, if I was Donald Trump and I was running for re-election, what I'd probably do is try to stall a trade deal, and then use that as political clout to say, in order for me to be reelected, you have to reelect me because you want me to finish off this trade deal with China, because if not, it's gonna be trouble for the market. So I don't know if we're gonna reach all-time highs, or maybe he will get a deal done before his election campaign and try to get something done. And if he does, could the S&P hit new highs? And that's really the risk here. But if we have peaked, and let's just say for argument's sake, there is no China-U.S. trade deal, and we have peaked, then we start looking around saying, okay, well, what are the currency pairs that we could possibly trade if the S&P does indeed start trading, from here. Let's say we start trading lower. That's when I start looking at currencies like, the dollar yen, which first and foremost, we'll look at the dollar yen. And the dollar yen, in my opinion, we are at risk of continuing to break lower. And we've seen the S&P starting to show some signs of, fatigue on the upside. And with the dollar yen, this is a weekly chart, by the way. What we're seeing is that dollar yen break down out of a triangle consolidation that we've had for the last 3 years. you can arguably say it's even longer than that. And some of you might say, well, yeah, Blake, but can't you go all the way back here? You could, but the fact of the matter is we're starting to break to the downside. So again, my opinion is if the S&P is indeed starting to come off, the dollar yen may be one of the better trades to trade to the downside. As the S&P comes off, I think this is a realistic, expectation for the dollar yen moving forward. And also, you think about like some of these supports down here at 104.50, 105, if those levels start to break, then you technically start making lower lows. And, we break below that spike low that happened, I think it was January 2nd of this year. We start breaking into 2019 lows. Now you're actually making not only lower highs, but you're making lower lows, which, in essence is a shift in trend. In this case would be to the downtrend. Now, a lot of you might go, well, if I trade the dollar yen to the downside, how effective will it be if I trade like the euro yen? Because you can see the euro yen is already starting to show signs of weakness. But I'm going to go back to the comments that I made a little bit earlier about the European Central Bank. The ECB, remember, they've had rates at zero. Okay, they've had rates at zero, and if stocks really start to come down, my opinion would be that the euro might unexpectedly be stronger than you'd think. So, and I'm going to go to the euro here in just one second, because this is something that myself and our firm, we talk about on a daily basis is, what if we have to see some repatriation, if you will, of euro dollars? Then if you've got the euro yen technically breaking down, okay, will the downside continue in the euro yen? Will it continue, or will we have some stabilization here in the euro yen, where most people would be like, oh, stocks are coming down, I'm going to go ahead and short the euro yen, that seems like a natural trade? My opinion might be that, hey, the euro may not be the best short. The dollar yen may be a great short, but the euro yen may not be the best short out there, because if you look at the euro dollar, okay, and this is a weekly chart of the euro dollar, we are in a descending wedge, right? Now, for those of you that follow, I'm a very basic technical analysis guy. I've been trading since the mid 90s. So, and my charts, and those of you that listen to me on a daily basis, you listen to our daily webinars. The one thing that I know you can count on me is that I don't change things up. I look at charts in a very simple fashion. I've looked at them the same way for years, and it's always done me well, because I'm a big advocate of the KISS theory and just keeping it simple. And I don't use really unorthodox technical analysis. I just use very basic technical analysis, but it's always served me well, because I do just keep it very simple. And for those of you that use Forex analytics, you know that our basic technical analysis and the analysis that I provide on a daily basis there is really going to show you as such, using relative strength and a couple, the 50-day and the 200-day moving averages that you see here, and basic technical charts, like in this case would be a descending wedge. Now, a descending wedge in technical terms is a reversal pattern by definition. Now, it's a downtrend. It's in a downtrend until it's not, meaning that once when we take out this downtrend line, it becomes quite bullish. And my suspicion is, if stocks start to sell off, one of the currencies that may be the unexpected star performer might be the euro. And if you go back to like Chris Weston's presentation just before this one, at the very end, he was talking about the CFTC data and how the market's extremely short the cable or the pound, and the market's short euros. That there's and if you think from a macro viewpoint, there's not a lot of people that want to be long euros. There's if you're talking about Italian debt, or where the European Central Bank has rates and they're not expected to raise rates, and But if the ECB keeps their rates at 0 and the Fed continues to lower rates, that there you get your expectation shift of the euro may continue to strengthen against the dollar. But more importantly, is the market is positioned on the short side of the euro. And if institutions need to, get out of their euro positions, their short positions, and come back into the euro, repatriate, if you will, we could see the euro unexpectedly start to strengthen. And this is why, for me, I'm not necessarily looking at the euro yen as a great short. The dollar yen may be a great short, but the euro yen is more questionable to me. And I think that we might actually end up moving sideways in the market in the euro yen versus it, going down aggressively with the S&P, which, most traders, I think, would expect. All right. So the euro is one of those currencies that has to be, on your radar in case the S&P does come down. Now, staying with the theme of some of the major currencies, I look at the cable and a lot of you would probably ask me, well, how about the pound? How do you feel about the pound? Look, I'm going to tell you right now that I'm staying away from the pound. And, with a possible hard Brexit on the horizon, I don't know if there's any reason to be long the pound right now. And I know I know for traders, we're all guilty of looking at currencies that you might feel are oversold or overextended, and they might be ripe for a reversal. Look, if we had a headline that hit the wires that there's been an agreement, it's not going to be a hard Brexit, I'll be the first one turning around and buying the cable. I will be. But unless I see some concrete evidence that I should be buying the cable, there's no reason for me right now to be looking at it. And I've been leaving it alone. And I mean, I've watched the bloodbath on a daily basis in the pound. I'm like, thank goodness I'm not long. And the next question you may ask me is, well, if you're not long, why won't you just be short? Well, the fact of the matter is I don't want, some news headline to hit the wires and me be stuck on the short side of the cable either. So I think there's a situation where, yes, it's too oversold to be, it's too weak to be bought, yet it's too oversold to be sold. That's kind of like one of the, current situations I feel with the pound. So therefore I tend to leave it alone. But going back to, go ahead. Yes.
Do you mind if I chime in?
Yes, absolutely.
Your analysis kind of dovetails very similarly with mine. I just wanted to expand a little bit on this. So let's take a look at cable first.
Yeah.
So there's clearly an upside risk. I think the upside risk here is that no deal Brexit gets taken off the table. It's looking actually bleaker and bleaker by the day, simply because Boris Johnson seems to be really pushing the country to the brink. But the underlying bet in the market, I think, is still that saner voices will prevail. If you look at the technical picture of cable, though, what's interesting is if you pull back to the weeklies, go back all the way. Oh well, no. So you are there. I'm sorry, you are there. I was just looking. The point of support is actually 119. So when you're looking for the shorts here, is it possible that it's very, very possible that we take out the 120s. There's just way too much temptation for the 120 stops not to be run. And of course, the flush there then takes us to that terminal point of 119. But the 119 is the true support point here on the charts. That's where I think it's going to become very interesting. That's really going to be the support line, the marginal line between all bets are off and UK is spinning out of Europe, or we're just going to wait a little bit longer, see leave the election cycle, see the second referendum, see whatever is happening, see Brussels come to the table, and consolidation there. And that's, I think, how you got to think about this. The downside right now is essentially 100 points max, unless you are 100% convinced that UK will no longer be part of Europe.
And I agree with you, and I'm not, and I didn't want to spend a lot of time talking about the cable. However, I'm in agreement with you that this could be, you know, in the current time frame of the next, let's say, 6 months, this could end up being the trade, one of those, generational trades for all of us that are participating, especially if we end up getting, everybody expects there's going to be a no deal Brexit, but you then in the back of your mind you always think, okay, cooler heads are going to prevail, they're going to figure out something before it gets done. But that's been a lot of people's arguments since we've been trading in the mid 130s. So the fact of the matter is, if we do get a resolution, the cable will reverse, and we get a no deal, or we get a Brexit, not a hard Brexit, but a deal is in place. This is going to be probably one of the best longs for all of us that are trading, but until that happens,
right, it'll certainly be good for 300-400 points of a short squeeze, maybe even more, because I think I think everybody agrees that under normal customs union conditions, it's a 125, maybe even 130 trade, simply because actually the UK economy, despite all the punches it has taken, has not crumbled just yet, but it is already starting to crumble. It's already starting to feel the impact of a hard exit. One other note I kind of just want to talk about, as you're looking at euro, I'm very much also in a similar agreement with euro. The euro is interesting from a lot of perspective. Yes, it's a falling wedge, but if you just zoom in on this, just from a pure candlestick perspective, it's a pin bar right there. Look at that pin bar on the weeklies. We had a mass. They rejected the 110s very, very strongly.
Very much so, and it was a false breakdown too.
False breakdown. Now, there's a million reasons why they could. I mean, there's still a million reasons why it could go down. But for now, I think from a fundamental point of view, one of the more interesting things to think about, and this is why they always say generals fight the last war. You were talking about how everybody's thinking about the great financial crisis and how the dollar was the trade into safe haven. Well, the situation is completely different now. If you look at the balance sheet of the two regions, the European balance sheet is far healthier than the U.S. balance sheet. We're running $1 trillion deficit right now with a massive, massive trade deficit. And this is very, very important from a political point of view, no longer the safe political place that we used to be because of incredible tensions in the country. Euro, on the other hand, for all of its troubles, yeah, it has anemic growth, but it's because of Germany. It's running a massive trade surplus. It is actually a positive surplus currency. That's one of the reasons why you could have that surprising move to the upside that people just don't expect.
Yeah, I think there's, and I think it'd be a very surprising move to a lot of people. And this is why I think we have to think about where we're currently at in the current environment, and think about the possibilities here. And technically, I think the market was caught off guard when we broke below 111, and then we did get that pin bar, and we closed on a false breakdown premise. I think the risk of the euro could be to the upside here, and I know the euro's trapped by a lot of gamma, a lot of options are placed around current levels. But that's not going to contain the euro forever. Let's just all realize that. And for those of us like Boris and myself that have been in the FX market for so many years, we know that the options market can trap spot price for only so long, and then it'll loosen up. And once it loosens up, it surprisingly might be actually to the upside. So I think we've got to keep that in mind, moving forward.
So I was going to say, if you don't mind, you may want to. Everybody is very interested in the website that you guys run, the Forex Analytic Market Analysis website. And if you have a couple of minutes, maybe you could just walk the group through what you guys do on a day-to-day basis, how your room plays out. I think everybody would definitely be interested in. And then I'll see if there's any questions after all that.
Sure, we'll do. Before I do that, I'll take you over to the Forex Analytics website, and thank you, Boris, for that. One trade, a couple trades I really want you guys to focus on, just because we talk about the dollar Mexican peso, and I was referencing how the interest rates at 8%, right? And one of the biggest carry trades out there has been the euro Mexican peso, which also I have down here. You can see the euro mex right here. If these have to unwind and you start to see, a sell-off in the S&P, well, what you would see is a downdraft in the peso, and the dollar mex is in a very tight triangle consolidation, and a break above 20 would be extremely bullish for this particular pair. And along with not just the euro Mexican peso, which we've seen those unwinds happen as volatility picks up, and it's very strongly correlated to volatility. As volatility picks up, the euro Mexican peso starts to rally. But if you look at some of these other currencies, like you have the euro New Zealand, which we just saw the RBNZ, they're talking about negative interest rates, and that's quite a fall from grace. If you talk about the RBNZ in 2011, where their rates were 8%, and now we're at 1%, possibly going negative. And if you have an upside risk in the euro, you take a currency pair like the euro New Zealand. Think about like the explosive moves that we could see here if the RBNZ decides to take the rates even lower, and the euro starts to come under upside pressure as you see people unwind the euro being deployed for so many years with the ECB at 0. If people start buying back euros and they continue to sell New Zealand dollars, we could actually see a very strong rally in not only the euro New Zealand, possibly the euro Aussie as well. And I know we have a lot of Australian listeners here right now, and think about where we're at now and where we have been in the past. And this is very much a potential risk-off trade if we see the euro rally. So I guess the focus I wanted to bring you to is, some of these euro crosses. Now, Boris had asked me to mention about Forex Analytics. So this is the Forex Analytics platform, as you see here. If you ever want to register for our daily webinars, we perform them for free every day. You don't necessarily have to be a member to listen to our face webinar. But when you log in, what you'll notice is, let me go ahead and log in. Whoops. Let's make sure I'm logged in correctly, which I'm not. That is not correct. Hold on. Oh, excuse me. All right. So that was our audio for that. What you'll see, here's the Forex Analytics platform. And what you'll notice here is that we cover 30 different instruments. And what we're covering is multiple methods of analysis, whether it's macro, candlestick, basic technical, harmonic, Elliott wave analysis, and you can click on any one of these analysis indicators and you can flip through them, whether you're looking at harmonics, Elliott waves, or basic technical, and you can see all the different charts that we upload throughout the course of the week. And all this analysis that you see here starts each week. We delete it so it just doesn't become overbearing, and we take off the charts that aren't relevant anymore at the end of the week, and we start off with a new week, and you can see all the analysis here. And what we try to do at Forex Analytics is apply multiple forms of analysis and try to get them to match up, because that's going to improve statistically if you have several methods of analysis matching up the same direction. It's easier to trade directionally in a pair. But we have all these different pairs, but we also cover the S&P. We cover the S&P charts. We have analysis throughout the course of the week, because I'm a very strong believer in correlation. So from cryptocurrencies, we just have some cryptocurrencies in there because of the demand, but we have precious metals, crude oil, the DAX, bonds, boons, and the epic rise in the boon market. You can see and how it's affecting the markets, and we're constantly talking about correlations in Forex Analytics. But the platform, we get all this analysis. We have calendars and Twitter updates, and you can have a customizable Twitter platform here, and our chat room where we have all of our traders logged in live throughout the course of the week. And there's probably about 100 of us that are chatting all day long in our chat rooms. You can see I'm extremely active in there, and you'll see like my face in there all the time. That's me right there. But our platforms are also mobile too. You see, we have apps that are on your tablet or on your PC, or excuse me, on your mobile device. So when you get a new update, you get a push notification. If the support and resistance levels are breached, you'll get notifications as well. And for those of you that are listening in, we have a special offer, which we're giving a 65% discount for a month. So you can try it out for a month at a 65% discount and see if it's right for you. And that's specifically for the
I'm sending that link right now to everybody in the group, so you guys can all have it.
Perfect. Thank you.
Okay, you guys should all be set. Okay. So thank you so much. It's an amazing website, really, really great analytics. I have made Blake my go-to follow now every single day. Let me just see if there's any. I'm just trying to see what questions we have here. They're just mostly comments. People are saying, well, some people are predicting a 4,000 move to S&P before we turn down. Other people are saying, triangles are not terminal moves that require a pullback. Honestly, guys, it's all. I'll let Blake answer that. I mean, it's all speculation. That's the whole point. Every day we come to the market with a certain assumption, and if the market changes, our assumptions change. At least that's what we do as good traders. So we're just simply sketching out what we see as a most likely scenario, which can easily change 150 degrees, 180 degrees if new piece of information comes in.
Oh, on a day-to-day basis. I mean, this is my long-term bias or your thesis on the market, but that doesn't mean that we're in such fast, ever-changing world, especially with the current administration in the U.S. Obviously, you have to stay very close to Twitter and close to the headlines and be watching them carefully, because the rules to the game can change at a moment's notice. But that's the great thing about being a trader, is my opinions can change at a moment's notice too. And I can try to predict all day long on what I think is going to happen. But one thing's for certain, Boris, and I'm sure you would agree with this, being in the FX market, for 20 years plus 20 plus years, in probably your case, interest rates do drive currencies and movements and interest rates expectations. And the fact of the matter is that most central banks are at zero. The Fed is not. And the Fed may be moving rates lower moving forward, and they've already signaled that they're starting to do that. But if you see, other central banks like the RBNZ, the RBA start to, race to zero, I think the Fed will be right behind them, and that's going to affect the rates and the currency market the way we see it right now.
I agree. I also think that we're sort of still living in that dream world of carry trade, when the economy was normal, when rates were normal, when global expansion, contraction markets were normal. None of those things are normal. I think the strongest thematic idea I've had, and I not that I wanted to have this idea, and I've really actually never wanted this to come true, but it just seems to be coming truer and truer and truer and truer, is that we're all turning Japanese. This is what's so insane, is that we're all in a world of, we have these two massive trends in the world that are utterly irreconcilable. In the advanced industrialized world, everybody's getting much older, and technology is getting much better, and demand is getting much worse. Because when people get old, the only demand they have is adult diapers. And the other incredibly societally disjoining variable is that old people are rich people, young people are poor people, old people do no work, take all the assets in this world. And I speak this as an old person, because I'm at this age, but I just think that if you think about it, 90% of all welfare in the industrialized, I'm talking about the G20 universe, goes to old people. That's how it works. They get all the health care, they get all the pensions, they get all the benefits of the years, and all the poor people, all the young people get nothing. And I think that distinction is really creating some incredibly skewed economic policies that we're running from. But that's a conversation for another end. I will leave everybody with those thoughts. Now, here's it is. As always, everything changes in the market, and everything changes with us in TraderFest as well. Linda seems to be having some sort of technical difficulties. So unfortunately, oh no, she's here. Oh, Linda. Oh, thank you. She is here. All right. See, I had a backup, Linda. I had my presentation already. I was already. See, I am a good trader. I always have.
You said you were running late, and you were going to send me a notice when to get on, and I never got. I just logged on. So.
Awesome. Perfect. But all I'm saying to you is, I am a good trader. I had Plan B ready, but I'm so glad I got with Plan A, because I definitely have the A personality, the absolute keynote speaker for my whole show this year, Linda Raschke. Let me shoot. I'm sorry. I'm just trying to bear with me. I wanted to get your slide up so that we can start talking intelligently here. Just 1 second, guys. I'm going to take the screen. Blake, thank you so much. You are a gentleman and a scholar. Blake has been just absolute rock in helping me with the TraderFest. I hope you guys really enjoyed it. I very much recommend you check out his website. It's amazing, and at very minimum, definitely follow him on Twitter. Okay, so
thanks for having me.
Thank you, Blake. Take care, man. So let me see. So here we go. Q&A with Mistress Market Wizard herself, Linda Raschke. Thank you so much for coming in.
Mistress. Ooh.
I knew you'd like that.
I'm a madam or a ms or a mistress. Okay.
Yeah, hey, I not that there's anything wrong with that. I go all the way. Anyways, Linda Raschke, as I tweeted out, and I mean this in the best possible way, has been trading longer than most of you have been alive. So we're going to, not that you can tell at all, but my point is, she has.
I use old photos.
She has more experience and has seen literally the evolution of markets from the most primitive to the most sophisticated. And most important, this is the incredibly interesting thing about her, is not only has she seen the evolution, but she has been the primary actor in every one of the changes of the trading revolution, including the current one, which is all algo computer driven. And we get a chance here to really explore a little bit of her history, her trading style, and then I'm going to ask, I have a whole bunch of questions from people who want to ask you stuff. But if you don't mind, since I get to run the show, I get to ask the questions first. I have a whole bunch of stuff that I wanted to talk to you about. And first and foremost, for those of you who are not familiar, maybe you could just give us a 30-second rundown of how you started and your basic history of getting involved in the markets.
I started on the floor of the stock exchange out in San Francisco, the Pacifico Stock Exchange. I was a market maker in the equity options. So that was my first background, was primarily doing a lot of arbitrage. And then I was on the floor of the Philadelphia Stock Exchange as a member there, doing the same thing, a lot of equity option arbitrage. And I started trading futures actually out in at the Pacifico Stock Exchange. I traded the S&P futures the very first day they were listed, and I've pretty much been trading them ever since. So that's sort of been my bread and butter. After the crash of '87, the options, the liquidity just totally dried up, and I started trading more and more futures. And then in '92, I became a CTA and started managing money with a futures-based program. And I was a hired gun for a couple hedge funds, and they didn't call them hedge funds back in those days. They call, so the terminology and the semantics of this industry has changed greatly. Just keep that in mind. But they were like managed accounts and then commodity funds, commodity pools. And then I eventually started my own hedge fund. Actually, I started several of them. And then I basically retired in, I don't know, was it like 2014, 2015 or something. I just stepped down as being a CTA and a CPO. I was also a commodity pool operator. So, and during that time, I mean, just in terms of the whole evolution of things, you know, I built up a business around me, a team. We had about $150 million, which is probably peanuts, you know, in the big scheme of what you hear of hedge fund money for global macro and stuff like that. You know, we just found big limitations as to what we could move on a shorter duration in the futures markets. So we kind of capped out at that level, which was fine. But in that process too, I had like a full-time programmer, full-time technology guys, and a lot of people probably don't know these things about me. I mean, I had even gone so far as to have bought my own server farm. We had about 140 servers. Each of these are the types of servers that could cost $80,000 a piece. So we really did make a huge foray into you know, the algorithmic systematic exploration thing. And part of that was because my current husband, who was also my original S&P broker, Damon Pavlados, had been partners with Steve Schuler. And there were three people, Dan and Steve Schuler and my husband, who had a brokerage firm on the floor. And they were the first to see the signs that the business was going to go electronic. And so developed an execution platform left upstairs. Then Steve and Dan went on to form GetGo, which was the founding firm of this high frequency trading market maker algorithmic type of operation. So, you know, I really saw all the inside and knew a lot of these inside players and could see what they were doing. You know, see the Citadel, the Peak Six, just the whole group of these guys that were doing the electronic market maker algorithmic functions. And of course, you know, this category of algorithmic execution, trading, whatever, I think is grossly misunderstood, but you know, there's several components of it. So anyway, those are perhaps some questions that I can help address to you today. I did retire. I had these idealistic notions of just, you know, going out and training my horses every day. I own two farms, one in Wellington and one up in Illinois, and several dressage horses and so forth. And I got bored to death after like 3 months. I was like, I felt like I was missing something every day. So here I am back in front of the screens. I took time out just to also write a book about my trading program, my trading philosophy, some of the horror stories that happened to me in the business, because people don't recognize all the obstacles and challenges and potholes, as well as, you know, your risk exposure to being on the outside of unforeseen events, even if you're just a day trader, you know. So I talk about being in a flash crash and all these kinds of things, but also to pass on so much of the wisdom that I had accumulated over the years from senior people that have now passed, and people that I greatly respect in the industry. So I took a little time to write that, which was also difficult because you're sitting in front of the screens every day. And so that book came out, Trading Sardines, and I'm not sure I'll write another book again just because it's so much work. But here I am still sitting in front of the screens every day, you know, because it's what I know. And just like anything in life, if you play cards or golf or piano or whatever it might be, your passion or your hobby, you know, you have to look at the markets as being really a passion and a hobby first. Forget about the fact that you can lose money or make money, you know, but you have to be in this business because you totally enjoy, you know, playing the game and trading, even though, you know, it still has frustrating moments and so forth. Anyway, I expanded well beyond 30 seconds.
Thank you. You know, I totally agree with you. I always end a lot of my presentations by saying this is the only business where we look forward to Mondays. And in FX, for us, we look forward to Sunday nights. I mean, there are very few people I know in businesses that say, I can't wait until the weekend is over so I can go back to work. And that is just such a powerful aspect of trading that people in some ways underestimate about how fascinating and interesting this enterprise is relative to a lot of other things in the world. So I totally agree with you about, you can't really retire. This is just too much fun to do.
Well, listen, it's fun about 20% of the time. It's
Yes.
a lot of tedious, a lot of patience, a lot of frustration and stuff too. And I'll tell you honestly, there's a lot of Mondays where I don't want to go back to work, but then of course you get caught up in it all again. So.
Yeah, no, I hear you. It definitely goes both ways. I want to go back just to the original, like, early days quickly, because you said something interesting, and I'd love to have you, because I think many people don't quite understand how this worked, and this could give a very, very good insight into how markets have changed. You said you used to do equity options arbitrage. Could you give an idea of how that worked in practice? What, like, one single trade that was an arbitrage trade, how did that work in the olden days?
Well, first of all, I was on the trading floor, and in those days that things were a lot more inefficient, so there's no arbitrage opportunity nowadays. You can sit there and do butterflies and condors and all this kind of nonsense and stuff, and there's zero edge because everything's priced exactly efficiently where it should be on a theoretical basis. So
Right.
On the trading floor, what we were doing, we were market makers. All right. So I should paraphrase that and say I was a market maker first, but the way that you do the market making in the equity options is that the order flow is very one way. So if you can imagine being in a pit where you're trading S&Ps, or you're a bank trader, doing Forex, or these types of markets, you pretty much get a two-sided market, paper flow back and forth. So the people in the pits would, okay, you buy the S&P and then you sell it out a tick. There's always constant bid and ask. And what happens with the equity options is that there would be one-way order flow. Like the customers, the clients, the retail, the institutions might only want to be selling a particular option series because they're doing covered rights for their stock. They could be long stocks, so they just want to come and keep selling options into the pit. And as a market maker, you have to take them down. That's your job, to make a market and buy them. Or conversely, if there's a takeover speculative particular stock, everybody wants to come and buy the options. Nobody wants to sell them to you. So your job in that case is to sell the options. So it ends up being a very one-sided order flow, and therefore you have to find creative ways to hedge that, because you can't just end up with unlimited directional risk. So you have to learn to either trade against the stock, buy stock, sell options, or buy the options and sell the stock and then trade the stock around it to adjust your position. It's dancing quite a bit. Very early on, I would say like in 1981, 82, there was enough of an edge where the options were out of line that you could buy, a different series in a different month and put on, for example, a calendar spread. You'd have to find where the order flow was going the other way in some other option. And then, of course, by the time expiration comes, the theoreticals, gravitate towards what they should be, and hopefully you made money. But yeah, it was just a different world back then, and it was a much more strategic world, and it wasn't easy because you had to work around these skews in having lack of liquidity in one series, and everybody wants to do the same thing in the other series, and it forced you to be a really good stock trader to adjust your position.
Now, what's interesting about that is these are classic sort of market making skills that you obviously learned early. They're all essentially mean reversion skills, and they are universal to every market that trades, and certainly universal to FX, which is a very dealer-driven market. And actually, what's happened now in the modern world is that these high-frequency algos, the Virtus of this world, the Citadels of this world, are actually the robotic versions of these market makers. They're always this is one of the reasons why volatility has been such a tough thing to trade, because they're always selling the offers, buying the bids, trying to dampen the moves and be on the opposite side. But I'm wondering, has your had those core skills that you had on you learned on the exchange, and then you moved over to Philly, and I'm sure you probably practiced those skills there. Has that whole behavior completely changed now that you're an when you move to become an upstairs trader, or do you still rely on a lot of those innate mean reversion market making skills in structuring models?
No, it completely changed in the 80s. I would say that it was all irrelevant and passe as of 1990. It was completely passe. So it doesn't matter. It just, what it did is it bought you time to continue to study markets, study technical analysis, try trading different markets, different products and stuff like that. It basically bought you time, about 10 years of education time. But in terms of the skills, I would have to say that the skill set for being a trader doesn't really have anything to do with the mechanics of the execution as much as you might think. The skill set in being a trader really has to do with your own steadiness and temperament and emotional control and planning and understanding the dynamics of speculation, in terms of when is a time to buy and when is a time to go against the crowd. Not that you're necessarily going against the crowd, but also understanding the type of strategies that you're good at. Are you good in a momentum environment? Are you good at breakout strategies? Are you good at, there's a lot of different variables like that. So
how would a person find out what they're good at? How did you find out what you were good at?
Well, the only way that you find out in probably 99% of different things in life is by trying. And that's why people so far underestimate the learning curve, is that you have to try it and see if it works for you, and then try it and see if it works for you. And this whole process can take 3 or 4 years. Let me try spread trading. Let me try seasonals. Let me try day trading. Let me try trend following. Let me try, you have to go through this process, however, whatever buckets you want to put it in. Let me try systems development. And this whole thing really takes at least 3 or 4 or 5 years at a minimum. And so whatever you start doing initially is like getting your toes wet, and it's going to get you into the process, but probably what you're going to end up doing for making a living is not going to be what you end up doing initially when you're starting out trading. You really have to find a niche, and different styles work with different people's personalities and temperaments.
Yes, but it also sounds like it's not just knowing your own personality and temperament that matters. It's finding the kind of trading, like you said, there's a million different trade strategies that can apply to a variety of personalities and temperaments. And it's actually discovering the kind of trade strategy that is in alignment with your own personality that it results essentially in a steady and confident performance going forward, right? It's not just the common thing I always hear is, first you have to really know yourself, and then once you know yourself, you can then apply a strategy. And I think that's too simplistic of you. Yes, you have to know yourself, but then you also have to go, like you said, and do all this work and try a whole bunch of different assets and strategies and everything else before you settle down on something that you are comfortable with. Would you say that's true?
Yeah, but you can't just be doing a smorgasbord of stuff. When you do test something out or try something, you have to really spend 3 months doing that just to see how the numbers play out, just to give it a fair shot. And you can't do more than 2 things at once. So for example, you might want to start off looking at, like, say, a volatility breakout system, because that is about the only mechanical system that I would ever consider. And I don't trade mechanical systems for a very strong reason, but that if I did, that would be the only one that I perceive as having a decent edge for a retail type of client. You know, trend following systems do not have an edge for an individual because the drawdown history can be way too long and way too steep. And the reason that trend followers survive is because they're making a management fee to run a very specific type of asset program, you know, for that complements a bigger portfolio for clients. Okay, so no individual retail. I've never met an individual trader that makes a living doing trend following in 40 years of seeing hundreds of thousands of traders, you know, but
Wow.
it will have an edge. Okay, it's just not going to work for an individual. And so
and yet the irony is that trend following is the single most common technique taught to retail traders over and over and over again. Yeah.
Well, but, you know, who's teaching these techniques? Obviously, people that aren't trading them and making a living off of them themselves. They're making their money teaching. Okay, so let's have a real good distinction there. Show me somebody that shows their real account year after year with their own trend following performance. Okay, and you know, so people need to be a little bit cynical and open their eyes here. You know, it's a very easy thing to teach because Russell Stans popularized it, you know, from that original Turtles program, and then Michael Covell wrote all these books and so forth. These guys are not trading for a living. Okay, so just be really clear on that. The point about trend following is that yes, there is merit in trading in the direction of the supply demand imbalance. Absolutely, that's where there's an edge. But what is not taught with the trend following is the need to do a portfolio of a minimum of 14 markets at once, because typically what will happen is 2 or 3 of those markets are going to make your stats for the year, you know, and you can get chopped up in the rest of them. So you're really playing for an outlier or a trend that is caused by change in central bank policy, these types of things. And then the other thing that is not taught at all about the trend following is the characteristics of the equity curve, the extent of the drawdown, as well as the duration of the drawdown. And every trend following CTA or fund that has been in business for 20, 30, 40 years, they have all had 40% drawdowns. And they have all had peak to valley stats that are like at least 10 months. Meaning, if you lose money, it takes at least 10 months to get back up to that high water mark that you were at. So these things are not taught to the retail. And so it does a great disservice in thinking that this is a viable strategy for them when the truth is it's not, you know. So that's my 2 cents worth.
Interesting. So you brought up a point, which is kind of your trademark in some ways, the ability to come back. I mean, anybody who's read your story knows very well, and in the new book, Trading Sardines, you talk about that as well, how many times, at least more, certainly more than once in your career, you've just had a tidal wave hit you for whatever reasons. The first time when you got blown out selling strangles, or it was a straddle or strangles, I'm not sure. Straddles on the Pacific Exchange, a time when it just happened, you know, the Fed decided to change rate policy on the close of the market, and you had sold a massive position in the S&P, all those things. And, you know, I wrote a column, I read a column like once a week for a lot of my retailers, and I wrote a column about Martin Brodeur, who is considered to be like one of the greatest goalkeepers in the history of NHL for one simple reason. He is able to completely shrug off a horrible game and come back the next game and just be a rock, be a wall. And if nothing characterizes sort of your success and history throughout trading, is just your ability to come back from adversity, whether it's self-forced or market-forced or just, you know, the fate of the gods. And so maybe, I know it's impossible because obviously, you know, they're very unique to you, but maybe you could just share just a couple of mental tricks or mental skills that you've acquired in your ability to come back from losers, because I think that's the single hardest and also the single greatest reason why most people quit It's not because they're doing badly. It's not because they're bad traders. It's because they just have one bad experience and they don't have the mental faculties to come back from that. Maybe you could talk to that a little bit.
Well, the mental faculties come from a confidence level in your own methodology and style. Okay, so that's really, really important. And it was interesting because, you know, I know that you met Mandy when she was out here in my office for a month. She traded with me for a month in July because she went to that Chicago Expo. And Mandy Porfrofen Johnny is actually a coach of sorts. She wouldn't, I don't know if she'd call herself a coach or what she calls herself, but she also trades. She trades, you know, every week and does pretty decently. So she made a big point about talking how when people get more emotional or reactive or these things that are disruptive to our trading, okay, one of the ways that you can recenter yourself and get back into the mindset that you need to be in for a trader is through statistics and you know, strategies and numbers and record keeping and these types of things that completely push out these disruptive, emotional, either reactive or despair or tilt type of tendencies. So be aware of the type of person that you are in the very first place. Richard Dennis, you know, and his sidekick there, when they were first selecting the turtles for their program on the trend following, made a very concerted effort to select people with a background in game theory or poker or mathematics. Liz Cheval was the only female trader who was selected to be in the Turtles program. Sadly, she passed at age 55 of an aneurysm, but she was a mathematician and she had gone down to the floor as a clerk, you know, in a different type of capacity, you know, before she applied for the program. As for myself, you know, I am very good at math and music and notes, and I'm terrible at words and writing books. I would have been the worst author or journalist, even though I spent like a lot of time. I feel like my Trading Sardines book came out pretty funny, but that was really hard work for me. And for somebody else, it might come a lot more naturally. So in the book, in chapters of the book, I'll talk about how, you know, my family growing up, we all played cards, you know, we all, you know, were very much, you know, both my brothers have their degrees in applied mathematics and, you know, engineering type stuff, programming type stuff. And it doesn't mean that if you don't have a propensity in these areas, you can't be successful, because Mandy proved that. She's not, she's quite one that is on the opposite end of this personality profile spectrum, but she says that she made a concerted effort to do the things that she needed to do, to start doing record keeping, to start doing statistics and things like that, you know, to keep her in a consistent groove. So for me, I always, I logged numbers at the end of every day for 40 years, for 39 years now. I still write down at the end of every day the closing price, the 2-period rate of change, make notes if there's patterns. I do a lot of modeling and testing by hand. You know, for me, if I ever had a bad drawdown or a bad trade or did something stupid, you know, which we all do stuff stupid, you know, I would immediately throw myself into research. You know, let me develop a new law, let me develop a new way of looking at something. Okay, well, I was on the wrong side of this. How do I be on the right side of this in the future? So it's tricky when we're traders that, you know, you don't ever see anything productive for your work. You can sit there 8 hours in front of the screen and lose money. And then what does that do for your productivity level? You never have anything to show for it, right? Right? So, you know, at least if you then go, okay, well, let me do back testing on this idea. Let me see what happens if we break out of the first 15-minute range. Let me model this. Let me see if I can create, you know, a new little color rule or something that pops up, you know, that alerts me in the future. So that's one good way that I dealt with, you know, getting myself back from an adverse period. And you just have to look at it one day at a time. You don't say, oh my God, I just lost $4 million. How am I going to make that back? No, you just go back in the next day and say, let me do my best job this day. And then the next day, let me do my best job this day, and so forth. And that's how you have to do it.
Interesting. You know what? Listening to you is just fascinating because I kind of do a lot of stuff which you do. I never realized it, but like when things go badly with me, I do the exact same thing, which is I go back to the drawing board and I say, okay, this strategy is not working. What can work? And very often, like, it's amazing how sometimes you can look at in your worst drawdown periods, you actually sometimes get amazing creative ideas, and you can look at stuff with fresh eyes and suddenly make tweaks and changes to systems that then, you know, create much better results as you go forward. But that whole mentality of like, let's go back to the drawing board and do research. I kind of did this naturally, and it's so fascinating to hear you say it because it gives me a lot of hope that maybe I'm on the right side of attitude doing that. So there's so many questions that I have.
Let's go, rock and roll. Hey, I've had my coffee.
Thank you, and I hope you guys can stay with us because, guys, I'm gonna go because how often do we get to talk to Belinda Rasky? I'm gonna go, and I really want to delve into some specifics. I know you generally like to talk about models and strategy, and your whole point is that tactics are the least important part, but I still want to ask you about tactics because it's fascinating to me. I'm just curious about your own personal tactics. So I'm going to ask you a whole bunch of questions, and feel free to ignore them or ask them, but I'm going to ask them in one single swoop. Do you enter single entry or scale in? Do you exit a single exit or scale out? Do you trail your stops? And how basically do you position size any given trade in terms of percent of equity? So those are like sort of my basic, mechanical questions. How do you approach all those things?
I'm all in, okay? I don't like scaling in because you're going to end up scaling into the losers, and you're never going to have enough in on the winners. Also, when you first initiate, that's when your risk is best defined, right? So I'm a strong proponent of do not scale in, all right? It's the worst habit in the whole frickin' world because you'll fall back onto scaling in, to average a cost. It's just a lousy practice. So I'm all in. Huh?
Yeah, I was gonna say, what about on the other end of it, on taking profits?
Yeah. Once you're in it, how you take profits and how you exit a strategy totally depends on the individual strategy and trade. Most of my stuff, it doesn't. You will, if you're trying to be a more systematic trader, it does you wrong to scale out. Okay, you want to be all in, all out, and I'll tell you where that is. There's variations in that. Okay, so let's say, for example, a volatility breakout system, just because that's a black and white model that is what it is, and I've got just numbers on a zillion variations of that going back so many years. So you're all in with that model, okay? Boom, it triggers, you're all in. And now, let's say your objective is to exit on the next day's opening, okay? Or exit on a test above the previous day's high. Something along the lines of, I'm sure everybody's familiar with Toby Crabell's work at some point because he did so much work on this, or Larry Williams for that matter. I mean, there's a lot of people that have publicly put out a lot of work there. And what'll happen is if you just take a piece off, okay, the whole point of these strategies is that they put you in the best position of capturing a fat tail. And that's the best thing about these markets that people should make a concerted effort to capture is you're always putting yourself in the position for capturing a fat tail. We just don't know where that's going to come from or how or when. It's called a big winner. And that's really what is going to make your bottom line at the end of the year. So is capturing a few of these big glorious days and so forth. And so if you get into the habit of taking partial profits along the way, you'll find that it's very easy to take partial profits on the stuff that is working, you know, and that's exactly where you don't want to take partial profits. So, you know, again, I'm talking about in a purist sense, in terms of pure numbers. In terms of pure numbers, you don't really want to scale out. You know, you want to be all in, all out. Now, there's the difference on that is there are certain patterns where it pays to trail a stop, okay? And you need to be very clear about what type of structure you can trail a stop on. So, for example, everybody's familiar with the concept of a continuation pattern, which could be a simple bull or bear flag. It does not model out to trail a stop on a simple bull or bear flag. There's just not enough structure there, and more often than not, it's going to stop you out by having a little bit of a give back, you know. So if you're doing a simple bull or bear flag, and I'm talking about over 1,000 numbers, of course there's exceptions to every single one, it'll model out best just to exit and take your profit. If you have, say, for example, a terminal wedge type of formation, you know, which we actually had at a lot of stocks in this last high in the S&Ps, you know, as well as some indices, that is a structure which demands a trailing stop, okay, because it can lead to a bigger win. So even if it doesn't work, you can see if you were trailing a stop on that breakdown from that market top, that is going to be the way that you capture the most amount of gains. And who knows, you know, I mean, some stocks you're probably still in if you're actually trading stocks, you know. So, and then if you are a day trader, let's say, for example, that you are a day trader in the E-minis. If we look at this individual market, it is the market that has the biggest length of line. And now what is length of line? Length of line is if you took the zigzags during the day, the little wiggles and jiggles, the 5 minute gives you a buy, you know, it rallies up for an hour, then you get a sell, it bounces down for a little bit. If we grab the ends, the opening and the close, and we pulled on it like a cord, like a clothesline, and straightened out all the zigzags, okay, this market has the biggest length of line. Not many other markets offer the same type of trading opportunity on an intraday basis that the S&Ps do. So if you have that type of market and you're on a shorter duration time frame, then absolutely that could be a case where it pays to scale out of your entries, because exits are never as well defined as entries, you know, with any model or strategy. And again, this is over 1,000 trades. You can't look at just say, oh, well, I saw one last week type of thing. So in that case, I know for those that do trade S&Ps, unless you're very good at discriminating those days that are trend days where you just need to stay with that trade all day long and even scalp in the direction of your position, okay? So what I'll do is if I am so fortunate to have caught a good trend day, which you might get one trend day a month per market, you know, on balance, the whole goal is to stay with your trade throughout the day. And this is where something like a volatility breakout system confirms that there's range expansion. You then can also find one or two spots during the day to scalp in the direction of your position as well. I am not a proponent of having a core position on, selling out part and then buying it back, and so therefore trading against your position. And once again, the reason is that a good part of the time you never really get that position back on again. So you'll be better off to have your core position and then have a scalping unit as well that you can trade in the direction of that. So for an example, gold and silver had a huge move, was it like last week, I think, Tuesday or Wednesday or something to the upside, or maybe Monday, I don't know, everything's a blur for me right now. But, you know, if you were long that, you want to think about staying long it till the close. And if you do get a little intraday pullback, you want to initiate another long and then scalp out of that for the small profits and therefore lowering your basis. So that's very different than adding, you know, at higher levels, which is not a good practice either. So that's my 2 cents worth.
So if I were to summarize this, it sounds like your basic essence is commit to the entry, commit to the exit, and trust the statistics. Trust your setup to.
That's very well put. Yeah, that's very well put. Everything is. You have to look at it in the context of the numbers, you know, of the law of multiple numbers, or the law of large numbers. That's what it is, the law of large numbers. You have to look at all that goes on in the marketplace as the law of large numbers, that it's only meaningful when you have a high sample size. And in the markets, you know, they always talk about with statistics, you know, confidence factors and this and that as being around this 34 to 36 is a reasonable sample size from which to draw conclusions. And actually in the markets, it ends up being more like 200 or 300. Okay, so you have to have a sample size of 200 or 300 before your confidence factor increases, you know, to the point that, yes, this has an edge, or this doesn't have an edge, or, you know, this is robust and durable and will hold up into the future.
Got it. Okay. All right. A couple of pro-con contrapositions. Tape reading versus indicators. Fundamentals versus technicals. And distinguishing noise from signal. Just sort of feel free to expound on any of all of that.
Okay, so tape reading versus indicators. They're all one and the same thing. I mean, you're basically tape reading an indicator as well, because you have to put an indicator into context. And an indicator is always going to be 1 bar late than the actual price. Okay, so, you know, if I'm tape reading, I'm watching price and an indicator. An indicator is just something to help smooth the data and add a little bit of structure if, you know, to the price. So to me, you can always have a hard entry, such as a buy stop. I'll give you a very common one. A lot of people like to use 5-minute candle bars. And for entry, let's say you've been in a downswing and you start to get a little bit of a bottoming formation, and they'll put a buy stop above the high of the candle bar. Okay. So are you treating that bar as an indicator? You might as well. It could be the same thing, because when you take that high out of that bar, you're going to have the first derivative of the price turn up, because the first derivative, which would be a stochastic or an RSI or any directional based indicator, is basically going to be 1 to 2 bars behind the price. Right. So I think that what you lose with the indicators is the importance of the levels. And that is increasingly important in these markets, that people understand, okay, this level was the high volume area where the, you know, most trading took place of the last 5 days. This level was a support level as defined by 2 previous lows. This level is the gap area where everybody sees the same darn thing in the market. So these levels where everybody in the market sees the same thing, and I'm not talking about Fibonacci levels or trader levels or Dan levels.
You mean like hard price levels? You mean hard price levels? Yeah.
Yeah. You know, that these are really important, and just general areas where you know, buyers or sellers came in the past. It could be, you know, what was the Globex high and low? When I come in the morning, and I know that you guys are on different time zones and you do different markets, even like Forex markets, but I still have a grid where I can look at the US pit session only for something like the euro currency or the yen, and I can see, okay, all of the New York, all of the US time frame players saw this amount of data during our day session the day before, and then I can see where do we open relative to where did we close, you know, based our US session. And usually, of course, you're going to have a big gap. And then you can have 2 reference points by which you're monitoring how the market moves. Okay, we gap width. Are we going to start trading back into the gap, even though the data itself is continuous, right?
Right. This is we got to stop here because this is such an interesting point, and I really want everybody to absorb what Linda is saying. This is such an interesting insight into the understanding that the psychology of the market versus the physical reality of the market, especially for us in FX. We are preconditioned to think that everything is continuous, right? But what Linda is saying and the way she studies this is that yes, it's continuous in an absolute, physical sense. That means the prices are always trading. But the reality of a guy who comes on a desk in New York at 7 o'clock in the morning, seeing the euro down 50 points from the New York close, or euro up 100 points from the New York close, or the customer, not even the dealer, but the customer who sees that when he gets on his desk at 7 o'clock, is going to create some very interesting demand supply dynamics that could be tradable, because his reality, he's not thinking about a continuous market. He's thinking, oh, I put on a position here and it's 100 points against me or 50 points for me. What am I going to do now? Is that what you're kind of referring to?
Yeah, but you have to think about, like, who are the major players in the forex. It's not the retailer, the individual trader, or anything like that. It's more on the short duration. I'm not talking about trend followers either. It's the banks, okay?
Right.
So you have a whole set of, you have different banks as each time zone opens. And so when we did our modeling of markets like the euro currency or the yen or the Aussie or whatever you're looking at, what we found is that if you modeled out the distribution during the day for when highs and lows are made for that particular day, and this actually goes true for just about any market, you will find that you don't really come up with any edge or anything that's notable as to, like, okay, we can say with the S&Ps, the highs are made at, like, 8:30 in the morning when New York opens or something like that. And we modeled it out like in 5-minute segments and 15-minute segments throughout the day. So, but what we did find is that if you break it into the sessions, here's Asia open, here's Europe open, here's US open. And for our US opening, we use 7 a.m. Central Time, which is actually 8 a.m. Eastern Time, because that's when everybody in New York is sitting down at their desks,
Right.
and the big players there with the banks and so forth, and Goldman Sachs or whatever. So if we model it out, dividing the day we actually did 4 sessions, because we actually called also when Europe closed, then the US afternoon session, because you don't have any players left. You will find that a lot of times Europe open or Asia open, the highs or lows for that session are made around the opening price. So you could then take a strategy like an initial balance breakout, which is a popular concept, a market profile concept type of thing. But initial balance, you can look at, okay, do we break out of the first 15-minute range? How do we trade off the opening price? Is there urgency off the opening price? These things tell us a lot about how that market's going to continue to trade for that session. So you can model out the Forex markets that way and come out with some really interesting things. So
Wow.
You see now the difference between indicator-based stuff, which completely loses the context,
Sure.
And of course it has value. If I have a bias, an upside bias in a particular market, you can bet darn well I'll be buying every 5 and 15-minute bull flag or a 15-minute buy divergence or whatever, it is. It's like little signposts along the way. Absolutely. They serve as wonderful entry triggers, but it's hard to make a strategy alone that will yield profits on a consistent basis that is strictly based off of an indicator.
Right. No, absolutely. I totally agree. I'm just, my mind is blown, because I just think what you just said is so interesting and so fascinating. I've seen this intuitively hundreds and hundreds and thousands of times over. I've seen also sort of like these massive reversals where you'll take pound. London makes a spike low in the pound at 8 o'clock in the morning London, and then New York just takes it right back up all the way to the other way. this kind of movement just seems to be continuous. And what I meant by customers, by the way, was yes, bank and their institutional customers, which are, some hedge funds and corporates and everybody else who are directly impacted on a day-to-day basis with this stuff. So it's just really, really interesting. So we're running out of time, but a couple of questions I just wanted to ask you. Favorite instrument, favorite market to trade, and maybe the answer to that is like there is none, because you are dispassionate enough to kind of not have a emotional attachment to anything. But maybe there is. Do you have a favorite instrument and a favorite market to trade, or something that you really are super comfortable trading?
Yeah, just to go back, because I made notes here. Technical versus fundamental. I look zero at fundamentals. Zero.
Yeah,
they do me zero. I'm 100% technical.
Right. And I heard that, and I'm just actually curious why, because I appreciate technicals, but all technicals are driven by fundamental change.
That's not true. Technicals are driven by the short-term crowd movement, people overpaying, it goes beyond where it should, herd mentality. Okay. Technicals are not fundamentals at all. The fundamentals are very long-term drivers, very long-term. They could be monetary stuff, in terms of like data and reports that come out, because we have those every day and all over the place. If you for one moment believe that like that information isn't known ahead of time, it's more the reaction, the market's reaction to the news, but everything's priced into the market well before you or I will ever see the data, So I just, the strongest fundamentals out there are going to be monetary data, and that is a very slow thing, even, okay, is the Fed going to drop the discount rate, blah, blah, blah. These guys are not stupid. They've got, okay, it's 65% odds, blah, 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 and they're hedged every which way up and down. And, you just get a lot of knee-jerk reaction in trading. And then, of course, they'll blame the market's swing on it, and then you look like a week later and it's completely different, and they're focusing on some other data point. So, yeah, fundamentals are very long-term drivers. They do not do traders any good.
Okay, we will agree to disagree on this one, but I will agree on one thing that I've heard you say before, and this is something that I personally do all the time, which is when news is good, but price action is bad, or when news is bad, but price action is good, is like one of the greatest setups there is. Meaning that,
yeah, but that's nothing to do with fundamentals. That's just telling you that the market's already long, or they're, I mean, if there's good news and the market sells off on good news, it's just simply telling you that everybody's already long and there's nobody left to buy. That doesn't have anything to do with fundamentals.
Okay, but my point was, it's a great signal. Like that's a trade. It's a trade that really works a lot. It works like 80% of the time for me, where if somebody sort of news comes out, there's this massive positive reaction, and then the price just starts going the other way, you trust the price, because price is going to give you a much more accurate signal of what's going on. Like you said, something else is going on that is far more important than whatever is the headline is. That setup really does work really well.
Yeah, but that's been written about for 100 years. That's been nothing new. I mean, they wrote about that in the 1920s and 40s and 60s. It's like, that's kind of.
Yeah, but it still works. That's the thing. It still works, and the problem is that a lot of retail traders. This is where the reason why I'm highlighting this is because retail traders actually do the opposite. So they'll look at the headline, it's positive, they buy it, the price starts to go against them, and they're like, but it's still positive. It should go up. I should be holding this trade. And of course, they wind up and they go, I don't understand the markets. That's sort of the very, very. I have like 1,000 questions about that particular dynamic. That's
why I revert back and I say just stick 100% to the technicals, and then you'll quit all the stupid brain talk in your head, because that's a problem for people, getting these little voices in their heads.
No, for sure. So favorite instrument or favorite market to trade, or is any market? It doesn't really matter.
The market that I'm making money in. My least favorite is the one that I'm getting chopped up in. Everything goes through stuff where you're in sync with something. I would have to say that the S&Ps have always been like my best market, because they offer the most opportunity, and you have a lot more information there by which you can read the market, such as market internals and you know, the individual stocks and leadership, and you know, it's just a gloriously three-dimensional complex game, you know, with relative strength and the other indices and so forth. You know, I would have to say, I mean, right now, I'm loving gold and I'm loving silver and these types of markets, you know, but I've gone through periods like where, you know, I've hated them too. So, you know, the energies are fabulous markets. They have their own time of day and rhythm. I started trading unleaded gas this year, and I've never really traded that before. So, you know, that's been a good market. It's not something I would recommend to somebody because the moves can be like very big and it's not as liquid. But, you know, it just. So I would have to say I used to love the bonds. The bonds were absolutely one of my best markets, you know, in the in my hedge fund. Like we used to keep the stats on where you know, our biggest wins would come from for the year. So one year, you know, the bonds were our best performing market, you know, but then when QE started, a lot of our models just simply stopped working. You know, a lot of the things that I traded off of, and you know, they became my most hated market. So you know,
you know, so we actually just had a conversation about that. Very interesting. The presentation before you was all about how dollar yen has completely stopped working as a correlation currency to the equity market, really since, well, the speaker was basically saying since Trump became president, there's been a massive divergence between FX and equities. But this is a very, very interesting point. And there's a question here from a reader. It says, do you change your trading strategies as the markets evolve and change, or do you stick with the same tried and true methods? I asked that in the context of when I remember reading an interview with you where you're talking about, you know, in the 90s, bonds and equities were 95% correlated, and then they completely became uncorrelated. And then I remember reading other commodity traders talking about the fact how orange juice, which was like, I think, I forget the relationship. It was either a buy the summer or sell the summer dynamic. And then Brazil came in as a major producer of orange juice, and seasonality completely flipped around the other way. And now we see sort of these century-old financial market rules completely get destroyed by the current reality of mass.
No. Okay, you're misinterpreting something. Okay. Correlations are not a basis for a trade because they change back and forth throughout history. In fact, I've seen, you know, the yen and, you know, the yen and bonds had like this perfect correlation for 3 years. And this is well before Trump. And then I had a friend who set up a fund that just did this ARB strategy. He had 3 people working for him. And it was based on this, you know, in the Forex market and stuff. And then the correlation completely fell apart. So if you actually go back and you look at 2 to 3 year periods in history, you'll see times, for example, where gold and the dollar were positively correlated for 3 years, right, and then times where they were inversely correlated. So correlations are not a basis for a trade. Seasonals are not a basis for a trade. All these external things are not bases for trades, just like fundamentals are not basis for trades. They are what add the color. They may or may not increase your confidence level. My style of trading, nothing has trade. I am there looking for, you know, can I call the directional bias for the day, and are there odds of range expansion for the day? Period. It doesn't matter what the market is. It doesn't matter what environment we're in. Can I find an edge where there could be range expansion, and can I find an edge where I've got a higher degree of confidence that it's going to be a low to high day or a high to low day, period. If some correlations or market volume or, you know, seasonal factors or commitment of traders report, you know, give me a little bit of a stronger feeling about it, that's great, but they're never the basis for a trade.
Interesting. Okay. All right. Sounds very, very good. Okay, guys, I'm going to just throw out, if you guys want to, let me see if there's any questions here that I'm just feel free to type in just the last few questions, because I've already kept Linda here 45 minutes beyond her time. I have a feeling, here's a question, I have a feeling I already know the answer, but I want to repeat this here. So Lachman is asking, I've seen candlestick patterns failing so many times that I've lost faith in them. Some have high quality patterns failing on daily, weekly, monthly, as well as on significant support resistance zones. You trade them. What's your view?
Well, I don't know what you mean by saying failing, okay? Because first of all, I don't use candlesticks on intraday data. I do love candlesticks on daily data, but a candle is telling you what's happened. It doesn't necessarily have forecasting value. It can tell you, let's say there's a fat tail, okay, and you know, like we had a fat tail in the bonds, you know, 3 days ago when we had that huge swing high and we sold off deeply, and then we sold off deeply the next day and then left a tail in the other direction and came back up. So they're telling you about that price action. It's not necessarily forecasting the next day. So they're not going to be, yeah.
So how do you absorb that action if you assign no forecasting value to a reversal candle or like a pin bar? What value? How do you assess it within your own trading then?
Well, it all comes down to context. That's what I'm talking about with indicators or an individual candle or something like that, is that it takes time and experience and, you know, many years to be able to put something into context. So for example, the huge candle that we had on the bonds, yes, that was a reversal candle. Yes, it left a tail. Yes, it might have been a, you know, whatever, a key reversal day. But we also had just made a very large standard deviation move in that market, you know, something like, I don't know what it was, 5 standard deviations or something. So typically, after a large standard deviation move, and really, I think that the Forex people should concentrate a whole lot more on understanding the concepts provided by market profile, okay, which isn't as linear as indicators and candlesticks, but it gives a lot more instruction on context. And so you just had a very large standard deviation move, and you could call, for example, if you looked at the Aussie dollar, that's called single time framing, probably the strongest trend there is. So when you've had a market that's been single time framing like that, typically what will happen is it comes back into balance. So with the bonds, when we had that big candle reversal, it's going to signal the start of a trading range more likely than not, as opposed to a whole nother swing down in the opposite direction. So because it was preceded by a large standard deviation move, now we're going to look for a rotational trading range. And it just so happens that these spike tails up and down are very fast, you know, urgency on the part of the market participants, but more of a short duration. Does that make sense?
Yeah, it does. It does.
Okay.
So that actually sort of like brings me to my final question. I thought I heard you say this, but I just want to confirm that you don't believe in 100% systematic approach. Is that correct? Or you know?
Hey, if I did, I would be sitting on a freaking beach drinking coconut drinks. Okay, seriously. After 40 years, and I told you I owned 140 servers. I don't even want to tell you how expensive that was, you know. So we were at the cutting edge of doing this stuff. Yes, there are entities that make insane amounts of dollars, 100% systematic. How do they do that? Let's look at the firms that do that. Renaissance Technology has been doing it for 20 years. They have 20 PhDs, the most insanely sophisticated infrastructure. They are working 20,000 patterns 24/7 in 74 global markets, all on extremely low leverage. Can you compete on that level? Can I compete on that level? No, absolutely not. You know, so, you know, if I have TradeStation and I love it for doing some modeling, am I ever going to create a system that I would trade that on a mechanical basis? No, but it doesn't mean that modeling doesn't have value. That teaches us things to learn about the markets. And if you want to look at algorithmic or systematic ways that you can smooth your bottom line, consider this. How about you as the trader pick the discretionary entry, and then you do what we call bracketing the market. You put in your initial stop, you put in your little exit strategy, and walk away. That's different because you selected that data point. It's not like you had an alert popping up saying, buy here, which doesn't necessarily have the ability to put things into context. That's one way. The second way is you're watching the market, you're tape reading, or you're watching your indicator, or whatever might be. Some people are not as confident in pulling the trigger. So therefore, put a buy or a sell stop in to pull you into the market, or bracket a trade. So what that would mean is, I want to buy the S&Ps down in this 62 area in general. I'm going to work a bid at 61.50 if they drop a little bit more, and if they don't drop, I'm going to put a buy stop at 63. So at least I'm in. If I don't get my bid and it turns, now at least it pulls me in. So that's another type of execution strategy that you could say is systematic algorithmic. And on the flip side of the coin, a lot of people like to pull the trigger themselves, but then let the machine manage the trade, because as you know, all objectivity goes out the window, and either people get overly anxious to take their trade off, or uncertain, or they get shaken out in the noise, and noise is not going away. You know, it's greater than ever, and it's a challenge for sure. The shorter the time frame you're on, the bigger the noise level. So I suggest you don't look at too short of a time frame. You will not make a living, because I've not seen it done.
Speaking of that, so my two final questions here. What do you think is a reasonable time frame for retail traders to look for setups? Like sort of a time frame where they have a reasonable chance of maybe having an edge.
I think if you go down and get away from the concept of looking at like 2-minute charts or 5-minute charts or something like that. I mean, you can look at a 2-minute chart for sure to fine tune your entry, okay? But you should really be looking at the 30, the 60, the 120 minute, you know, or 240 minute to have the wind behind your back. So you can use a very short-term time frame to help monitor and your confidence level, you know, at getting in at a good trade location. But here's the difference. You want to be seeing that trade location on something that it's at least higher than a 30-minute time frame, you know, 6 hourly, 2 hourly, you know, that type of thing. Okay. So there's room for both to work together.
Okay. Now, and the final question, you know, I've always say this to people, is that low leverage will wash away a multitude of sins. Like the single biggest mistake most people make is that they just simply over lever and they don't give themselves the time to make mistakes. So I think you're pretty much in agreement with me on that. But what I'm actually curious is, if there was a, you know, young Linda Raschke with $10,000 in her retail account, what percent risk, you know, and she was starting out, would you recommend she take on a trade? What kind of lever factors should she use to give herself the minimum amount of chance of not blowing up, or of just sort of surviving?
You know, if you're first starting out, you should be doing no more than one contract, or the smallest size, the smallest, teeniest size that's a notch above trading a simulator. All right, you want to be, until you can show some consistent profitability over a 3-month period. And I don't mean getting lucky and having 3 great trades in a 3-month period. I want to see a steady equity curve of at least 3 months.
Right.
Probably more like 6 months before you even start to discuss leverage and percent risk and all that kind of stuff.
Would that go back to your idea of sample size? So 3 months, you know, if you're day trading, what you're saying is that you really want to do a couple of hundred trades and have a, you know, positive record after a couple of hundred, maybe even 300 or 400 trades before you even have any sense that you're doing something correctly.
I want to see somebody have a hard and fast and true methodology that they've modeled, that they have a high degree of confidence in, and they're still not futzing with. And people, what'll happen is, you know, there'll be an error or a loss or something like that, and then they're immediately tweaking their strategy, okay, you know, or what they're looking at. Right. I want to see somebody arrive at something, then say, I've arrived. I am trading, you know, volatility breakout system, or I am trading, you know, hourly buy divergences, or you know, this is what I do. I want them to reach that point before you start increasing your size. And I want them to prove that, you know, that this is what they're doing, you know, by some consistent performance record, and then prove that they also have the mental temperament and fortitude that they're not going to start doing all these marginal trades on the side.
Right. Interesting. Wow. Okay. You know what? That's the best advice ever. I think I'm going to cut it here. We've gone an hour over. I feel like Howard Stern, you know, like who always goes.
Well, you're a great moderator. You really are. You know, you pick out good questions, and you immediately, you know, put them into the wraps with, you know, the environment that you're in, and the arena that you're in. And you know, my parting thing that I want to say is that, you know, it's all good. You know, this is such an amazing field to study till the day that we die. And what I see with the people that really make it is that just like you, trading is your lifestyle. It's not like a day job. It's not like day trading. It's like the people that you hang out with. You know, if you're with a spouse, you introduce them to it. You know, you have a club, you have your buddies, you have friends online. You're always ordering books. You're always playing with the charts. You're always doing your own research. You know, I mean, you know, it really, it takes a lot of hours, but so does any person that has their own business. You know, if you're an entrepreneur, or you're a professional golfer, or you're a professional rock and roll star, look at these guys that, you know, I just saw Mick Jagger. It was so cool. He was like in his mid 70s, and he's up there touring in Chicago. And I mean, this dude is like, he's on planes all over the world. He's traveling, he's practicing, he's recording this, that. This is his lifestyle. This is what he does. You know, and so it's sort of the same in the trading universe. You know, if I look at these people that, you know, my husband used to do the execution for Paul Tudor Jones, or these very, you know, well-known names and stuff. This is what they do. Tudor Jones has monitors and screens in his bathroom walls. You know, I'm sure he's, you know, graduated a little bit away from that, because he's got so many people now that operate more systematic profit centers. But you get the point. You know, these are the people that you hang out with and the functions you go to.
Right. These days, all we need is an iPhone, but we get the same concept. We're definitely there. Belinda, thank you so much. Thank you for staying longer. Enjoy the weekend in Chicago. I hope it's nice and sunny like it is in New York, and you have a great time. We're going to obviously record this video. This interview has all been recorded. I'm actually going to go through it. I'm going to do bullet points. There were just so many incredibly valuable kernels of wisdom. I'm going to extract all of that for you guys. Please, everybody, go to Linda's website. I will send out the link, and buy her book, Trading Sardines.
It's very thoughtful. Yeah, it'll make people laugh. I promise. It's not a dry, boring trading book.
Definitely not. Definitely not. And thank you one more time for just entertaining us. It's been a pure pleasure. Everybody have a wonderful weekend. I'll see everybody tomorrow at a bright early time of 6 o'clock in the morning, New York, and 8 p.m. Australia. And Linda, thank you once again. Have a great weekend.
Everybody have a good weekend.
Bye-bye.